Hearing will come to order. Today's hearing will focus on tax policies that will strengthen our economy, our balance sheet, and our nation's financial health now and into the future. And I would like to now yield myself such time as I may consume for an opening statement. I want to thank our members and the witnesses for being here today. This hearing is the second in a series on growth entitled Incentivizing Economic Excellence Through Tax Policy. Economic growth and prosperity, I believe, is the tide that lifts all boats with more and better jobs, higher wages and income, lower unemployment, lower poverty rates, and an overall improved standard of living for all Americans. But as we've discussed, and I think most of us believe, a vibrant and flourishing economy would also strengthen our balance sheet and improve our nation's fiscal health by generating revenue to the Treasury, as we've witnessed since the Tax Cuts and Jobs Act of 17. That revenue will help us pay our bills and fund our priorities. We'll also reduce our financial risk, lower our interest payments by bringing down our debt to GDP ratio, and then ultimately helping us stave off a debt crisis. Last hearing, we examined the effects of excessive and overreaching regulations and how they compromise our freedom, quench the entrepreneurial spirit, and suppress economic growth. We noted that President Biden, his regulatory track record at this point is 2 times previous President Obama, and the overall cost is at $360 billion. That is a major drag on the economy. We're going to focus today on the relationship between tax policy and economic growth, and again, its fiscal impact on our country and our country's future. Unfortunately, we are far from a rigorous and thriving economy today as our nation continues and our working families continue to suffer from sustained 40-year high inflation. And inflation is coming down. I want it to come down, but core inflation is sticking, and it's about the same as it was over the first year of this administration. We've seen the fastest pace of interest rate hikes in history. We've experienced 3 consecutive quarters of economic decline, with the most recent quarterly output at just around 1%. This is a direct result, in my opinion, of too much spending and wrong-headed policies. And I'll spare you all the litany of failed economic policies and the $11 trillion in spending that I believe have put us in this tough spot. And then for me, and I think most of our members, it's added $6 trillion to the national debt, which is already on an unsustainable course. We have to examine the relationship between good tax policy and our budget process. Congress has the power to tax. In 1913, the 16th Amendment gave us the power to tax directly to income. But what we pay for, the scope and mission of our republic, who we tax and how we tax, is of the utmost importance as we seek to responsibly pay our bills and encourage growth and ensure the financial health of the United States. History is replete with the evidence that when you reduce the tax burden on job creators and consumers, the economy grows. Kennedy did it, Clinton did it, Bush did it, Reagan did it, and whether it was significant or modest, the result was the economy grew. In fact, President Kennedy said that economic growth in the post-war era was the most urgent task facing our nation, which is why he proposed a tax reform package that, by the way, included a significant reduction in the corporate rates. He said it was to step up the growth and vigor of our nation's economy, increase job and investment opportunities, and improve our productivity. As President Kennedy said, completing this task was about protecting the security of our people. Let me jump to the most recent example, the Tax Cuts and Jobs Act. Very proud of what we did. Would it have paid for itself? It's a good question. I think that'll probably be raised by some of my colleagues. I don't know. I know that the economic feedback is positive. I know that we brought in more revenue than was projected and had to be upwardly revised several times by CBO. I think Republicans made a mistake not to include spending cuts. I'll say it, and I'll continue to say it. For a party that's so obsessed with out-of-control spending, for us to have the House and Senate and the presidency and to pass tax cuts and tax reforms and not reduce spending, which I think is the preponderance of the problem, certainly one of the two pieces of the equation here, growth and reduction in spending, I think is more than disappointing. I think it's shameful, actually. And we can't repeat that if we are given the opportunity. But what tax cuts and tax reform did was to generate more capital investment than we've ever seen, more R&D investment than we've ever experienced. We had the lowest unemployment rate. We had the lowest poverty rate in recorded history. 6 million people lifted out of poverty. A lot of benefits accrued to this country. Namely, people were having better opportunities, higher paying jobs, and they kept more of their money. And that we experienced an economic renaissance. Rather than to go through all of my notes here, because I know I've filibustered before, I would just say we have to have the most simple and efficient tax code. We have to find a way to make it more simple and simpler and more efficient. We have to have a fair and equitable tax code. And there's going to be debate about what that means. For me, to have 40% of the American people not having any stake in their country is a problem. To have the top 10% paying 75% of the taxes, I think that's a problem. I think that's inequitable. But we can debate that, and we should. And then finally, we need a productive, the most productive and most competitive tax rate. We can't have China, communist China, have a lower tax rate on their businesses, their job creators, than we do in the United States. And even today, after lowering the corporate rates, you combine the state taxes on businesses and federal taxes, we're paying more than businesses in communist China, our competitor and our adversary. That's a problem. So let's work together, try to figure out how to get this right. We know the formula for success after World War II: cut spending, right-size the government, the bureaucracy, take on entitlement reform. That'll be a fun discussion. We haven't gotten there yet, but let's figure out how to grow this economy and leave our children a better country in a better spot with a brighter future. And with that, I yield to my ranking member for such time as he may consume for his opening remarks.
Well, thank you, Mr. Chairman, and glad to have this hearing today. Number of things I wanted to respond, and maybe some other occasion or some other format we'll have a chance in a respectful, of course, way to go back and forth on some of these points that you raise. First, I would say, before I even get to my opening statement, we know definitively the answer to the question whether or not the Tax Cuts and Jobs Act paid for itself. The answer is no. And don't take my word for it. Sitting right at that chair, our guest at a previous hearing, Douglas Holtz-Aiken, clearly a well-respected right-of-center economist, his exact quote, so I don't misquote him here, 5 years, when asked the question whether or not, I think it was, actually I believe I was the one who asked him the question whether or not tax cuts entirely pay for themselves, he said, quote, "No serious economist would make such a claim." Now, tax cuts do have some stimulative effect, more of an effect when they're targeted in the right way versus others. But no, of course, they never entirely pay for themselves. Heck, if they did, then why not have a tax rate of 0.00001% if we thought that they were, oh wait, some of my friends might take me up on that, oh geez. I think I just won the 2024 Republican nomination. But of course they don't pay entirely for themselves. Money does not grow on trees. And the reality is when another witness testified to this, if people recall, I like to do callbacks for those longtime viewers of our hearings. When you add up the two Bush tax cuts, 2001 and 2003, and then of course they were extended jointly under split rule, President Obama and the Republican-led Congress, and then you add in the TCJA, we are missing $10 trillion. So when you look at that national debt figure, recognize that where some of that debt comes from. I'd also point out, since a favorite president of mine, JFK, was invoked, it is true, he did push for a tax cut. I'm not sure my Republican friends would like us to go back to what the marginal rates were after those tax cuts. They were significantly higher than the taxes we have today. Indeed, we have some of the lowest tax rates right now that we have ever had since having this modern system of taxation. Now, part of the title for this hearing is, quote, Reigniting American Growth. I have good news. It is already happening. More than 13 million jobs created over the last 2.5 years, the lowest unemployment rate since the 1960s. More jobs have been created in this presidential term than any other single term in American history. On inflation, with the latest data that came out last week, inflation has now dropped for 11 consecutive months. It is still higher than what we would like it to be, but my goodness, are we in a different world than our friends in Europe? Their situation is much worse on inflation, without the signs that it's necessarily going to get better soon. On this point, I had a German parliamentarian, a member of the Bundestag, in my office last week, a good ally of the United States. He was talking about the situation they're facing in terms of inflation and expressing the wish that inflation was in Germany what it is in the United States right now, with dropping so heavily. So once again, as I've said here many times, the United States continues to lead the worldwide recovery coming out of COVID, and we need to make sure we don't do anything that would jeopardize that. Now, finally, let me say on the other half of what I think this hearing will be, the trade picture, I'm glad that we're having a hearing talking about trade. We are 4% of the world's population. Sometimes, it's very easy, being Americans, it's very easy to forget that 96% of the world lives outside our shores. Mark Twain once said, America's two best friends in the world are the Atlantic and the Pacific. So sometimes we can have a more parochial view. The reality is, being only 4% of the world's population, we do need trade. However, I think it is clear, and in some ways, there might be Democrats and Republicans who agree on this. I think there have been trade deals over the last quarter century that have not paid close enough attention to the needs and concerns of American workers, especially America's blue-collar workers. There was a victory on that front, a bipartisan one that is, not really talked about that often, and that was the revision of NAFTA, USMCA, a deal in which for the first time you saw a majority of organized labor in support. It got over 400 votes in the House of Representatives. The same number of House Democrats and House Republicans voted for USMCA. So it shows that this isn't just rhetoric. I am a believer that we can have trade agreements that are in our national security interest, but also balance the need for growth and the balance to drive good prices for American consumers with also protecting the interests of American workers. So with that, I will yield back and look forward to hearing from our witnesses.
I associate myself with the remarks of my colleague on trade, and I look forward to opening up new markets, new customers for American producers and manufacturers. With that, I want to thank my colleague and want to make mention that if any member has an opening statement, you can submit it for the record. I'll hold the record open to the end of the day to accommodate those members who may not yet have prepared written statements. Once again, I'd like to welcome our witnesses. Today, we're going to hear testimony from Dr. William McBride, Vice President of Federal Tax Policy, and at the Tax Policy Foundation, Mr. Kyle Parmalu, Senior Fellow on Tax Policy at the American Enterprise Institute, Mr. Kevin Kuhlman, Vice President of Federal Government Relations at the National Federation of Independent Businesses, and the Honorable Mark Mazur, former Assistant Secretary for Tax Policy at the United States Treasury Department. And we all extend our appreciation for your time and your insights. Committee's received y'all's written statements, and they'll be made part of the formal hearing record. You will each have 5 minutes to deliver your oral remarks. Now yield 5 minutes to Dr. McBride.
Thank you, Chairman Arrington, Ranking Member Boyle, and members of the committee. I appreciate the opportunity to speak with you. My testimony will focus on the economic effects of recent changes to the federal tax code, including the Tax Cuts and Jobs Act, and recommend ways to boost economic growth going forward. TCJA reduced income tax rates broadly, both for individuals and corporations, lowering taxes for every income group and improving incentives to work, save, and invest through lower marginal income tax rates on labor and capital income. Lowering the corporate tax rate in particular improved the long-run health of the economy by reducing the tax burden on corporate investment. As a result, the Joint Committee on Tax and the Congressional Budget Office both predicted more investment, more labor supply, and faster economic growth. However, several temporary features complicate the law and reduce its impact. On the individual side, all of the individual income tax cuts expire in 2025. On the business side, the ability to immediately deduct R&D expenses ended last year, so businesses are now required to delay those deductions for 5 years. Likewise, bonus depreciation initially allowed businesses to immediately write off the full cost of equipment, but now depreciation rules are returning that require businesses to delay those deductions for up to 20 years. We found TCJ's positive impacts on the economy would build in the first few years, resulting in a 3% increase in GDP and a 1.7% increase in wages by 2025, with smaller impacts in the long run. Comparison to actual outcomes is difficult due to confounding events such as the pandemic. However, at a high level, several measures point to a strengthening economy post-TCJA. GDP, investment, and labor compensation all improved in the 2 years after enactment of TCJA and before the pandemic relative to historic averages. Regarding tax revenue, while TCJA was estimated to reduce revenue initially, both our analysis and that of the JCT indicated it would raise revenue by the end of the budget window. Actual tax collections have exceeded expectations, hitting an all-time high in nominal terms last year of $4.9 trillion and 19.6% of GDP, which is a 22-year high. Average federal tax collections in the 5 years since TCJA's enactment are higher than forecasted by the CBO, higher than most years leading up to TCJA, and higher than the long-run average. In contrast to TCJA, President Biden's tax proposals would raise marginal income tax rates. While the proposals are ostensibly aimed at high-income earners and businesses, they would depress economic activity generally and reduce opportunities for workers at every level. Revenue raised with these tax hikes would in part be spent on tax credits and other subsidies for specific industries and taxpayers, further adding to the complexity of the tax code and expanding scope of the IRS. Going forward, lawmakers should focus on simplifying the federal tax code, creating stability, and broadly improving economic incentives. As a first step, lawmakers should permanently extend R&D expensing and bonus depreciation, a policy which would boost GDP by 0.5% over the long run and add about 87,000 jobs. As 2025 approaches, when much of the TCJA expires, lawmakers should consider fundamental tax reform to systematically address the tax code shortcomings. While there are many options, we have recently detailed and analyzed a proposal that would substantially boost economic growth and opportunity. It follows along the lines of the Estonian income tax system, which tops our annual ranking of most competitive tax systems. The reform would fully integrate the corporate and individual income taxes to avoid double taxing corporate income. Instead of a complicated corporate income tax and separate rules that apply to pass-through businesses, all businesses would be subject to a simple 20% tax on distributed profits, At the individual level, a simple flat tax of 20% applies to all individual income except dividends, since they are already taxed by the distributed profits tax. Capital gains are taxed as ordinary income, also at 20%. Rather than a complicated estate tax like ours, the tax is accumulated savings at death. Bequeathed assets are simply taxed as capital gains when sold by the heir, with deductible basis determined only by costs incurred by the heir. We find if such a system were implemented in the U.S., it would greatly simplify the tax code, saving taxpayers more than $100 billion annually and reduce compliance cost. In addition, our modeling indicates it would increase GDP by 2.3% in the long run, raise wages by 1.3%, and add 1.3 million jobs. My written testimony goes into other ideas along these lines. I'm happy to answer any questions you may have about that. Thank you for your time and attention.
Thank you, Dr. McBride. I now yield 5 minutes to Mr. Parmalee.
Chairman Arrington, Ranking Member Boyle, and members of the committee, thank you for the opportunity to testify today. I'm Kyle Parmalee, Senior Fellow at the American Enterprise Institute. In my testimony, I'm going to put the Tax Cuts and Jobs Act's corporate tax proposals in an international context. I will make 3 points. The first point is prior to the TCJA, the U.S. corporate tax code was an outlier among the 38 countries of the Organization for Economic Cooperation and Development, the OECD. 2, the TCJA brought the U.S. corporate tax code more in line with those of our major trading partners. And 3, lawmakers should be cautious about some of the proposals in Biden's budget that could once again make the U.S. corporate code an outlier. So before the TCJA, the U.S. corporate tax code was an outlier in the developed world in a few important ways. The statutory corporate tax rate was 38.9%, which was the highest in the OECD. At the same time, the U.S. also levied high effective tax rates on corporate investment. The U.S. was also one of the last OECD nations to tax U.S.-based multinationals on their worldwide income. The pre-TCJA corporate income tax created several issues. First, the high statutory tax rate, combined with the ability to defer additional U.S. tax on foreign profits, encouraged corporations to shift profits and headquarters to lower tax jurisdictions. Second, high effective tax rates discouraged investment in the United States and encouraged corporations to locate highly mobile assets, such as intellectual property, overseas. And third, the high statutory tax rate, combined with the ability to deduct interest expense, resulted in a large bias in favor of debt-financed investment. The TCJA addressed many of those issues and brought the U.S. code more in line with those of our major trading partners. So reducing the federal statutory tax rate to 21% brought the combined statutory rate to about 25.8%, which is slightly below the OECD average of 26.2%. The lower rate reduced the tax burden on new investment, and in combination with the limitation on net interest expense, also reduced the bias in favor of debt-financed investment. And current law tax treatment of U.S. multinationals' foreign activity, which exempts the returns to tangible assets but places a minimum tax on intangible assets, is more aligned with how other OECD countries treat their multinational corporations. But by no means were the TCJA's corporate tax provisions perfect. For example, some of the TCJA's tax cuts for new investment were temporary, such as 100% bonus depreciation, and the Tax Cuts and Jobs Act raised the tax burden on research and development in the United States. And second, the new provisions aimed at preventing base erosions and profit shifting of U.S. multinationals have several known shortcomings, and the tax rate on these provisions are scheduled to rise after 2025, creating uncertainty for corporations. Lawmakers are right to want to extend both 100% depreciation and delaying amortization of R&D, but those changes should be made permanent and prospective, not temporary and retroactive. And looking forward, lawmakers should continue to expand expensing further and limit the deductibility of interest expense. The last point I want to make is that lawmakers should be cautious about some of the proposals in the Biden administration's budget. In its last couple budgets, the administration proposed raising the statutory corporate income tax rate from 21% to 28% and proposed significant reforms to the tax treatment of multinational corporations' foreign profits. Under these proposals, the U.S. corporate tax rate would be 32.5% and the second highest in the OECD. Effective tax rates on new investment would also be among the highest. And despite new limitations on interest expense, the proposal would also increase the bias in favor of debt-financed investment. The Biden administration argues that its proposal to reform the tax treatment of multinational corporations would align the U.S. code with the global minimum tax, or Pillar 2, the OECD's proposal, but there would remain meaningful differences. In fact, their proposal would place a heavier burden on multinational corporations headquartered in the United States than Pillar 2. So under the Biden budget proposals, it would be less attractive to be a U.S. headquartered corporation, even if all countries enacted Pillar 2. Thank you, and I look forward to any questions.
Thank you, Mr. Parmalu. Now we would like to yield to Mr. Kuhlman. 5 minutes for your opening remarks.
Thank you, and good afternoon, Chairman Arrington, Ranking Member Boyle, and members of the Budget Committee. My name is Kevin Kuhlman. I'm the Vice President of Federal Government Relations at the National Federation of Independent Business, NFIB. Appreciate the opportunity to share the small business perspective today. Small businesses face economic challenges, including stubbornly high inflation and pervasive workforce shortages. Additionally, small businesses face a very uncertain tax future that makes business planning extremely difficult. Beginning this year, certain business provisions of the Tax Cuts and Jobs Act of 2017 expire. In about 2.5 years, the vast majority of the provisions that benefit individuals and small businesses will also expire. If Congress fails to act, there will be a detrimental and substantial tax increase on millions of small businesses. Further, proposals to increase taxes on businesses cloud business optimism and complicate business planning. Small businesses receive significant tax relief upon the enactment of the Tax Cuts and Jobs Act. More than 3/4 of businesses are organized as pass-through businesses, either S corporations, LLCs, sole proprietorships, or partnerships. Business income is passed through to the individual owner's income tax form, 1040, where individual income tax rates are applied. For pass-through businesses, the 20% small business deduction, also known as Section 199A, combined with the lower individual tax rates and broader income brackets, provided tax relief that was invested in small businesses and their employees. For example, Lana Paul, owner of Geetings in Pella, Iowa, testified before this committee a couple years ago that the new small business deduction will provide around $40,000 in tax relief for our businesses. This tax relief provides crucial cash flow that allowed us to provide up to $4,000 raises for our employees, the largest compensation increases we have been able to provide in recent years. Retaining highly valued employees is key for our businesses to function. The small business tax relief was plowed back into people and production, not owners' pockets. Unfortunately, these provisions expire on December 31st, 2025. Nearly half of small business owners reported that uncertainty of expiring tax provisions is impacting their current and future business plans. Fortunately, Congressman Lloyd Smucker, a member of the Budget Committee, will reintroduce the Main Street Tax Certainty Act during the next congressional work period. This legislation would make permanent the 20% small business deduction, providing tax certainty for small business owners to grow their businesses. NFIB urges members of Congress to support this legislation by joining as an original co-sponsor. Further clouding business planning are proposed tax increases on small businesses. President Biden's fiscal year 2024 budget requests would increase taxes on small businesses organized as corporations and pass-throughs. I included a list of certain tax increase proposals in my written testimony, but I would like to focus on the proposed 5% small business surtax on pass-through business income. The President's budget request describes this small business surtax as, quote, closing a loophole. The tax was originally created as part of the Affordable Care Act's reconciliation bill as a tax on investment or passive income. It was a deliberate policy choice to not apply the tax to active business income, which of course is not passive income. As former chairman of President Obama's Council of Economic Advisors, Jason Furman, described, it was not applied to active business income, quote, because it could be demonized as a tax on small businesses and doctors, end quote. A deliberate policy choice is not a loophole. The proposed expansion of the tax would more than double the revenue collected, further demonstrating that the tax increase proposal does not close a loophole. If it is ultimately enacted, this substantial tax increase would reduce the ability of pass-through business owners to invest in their businesses and employees, as well as leaving them at a further disadvantage relative to corporations. Over a few months, NFIB collected over 21,000 signatures from small business owners throughout the country opposing this small business surtax and stating emphatically that small business is not a tax loophole. Small business owners shared their concern. For example, John Sullivan, owner of Dana Walbird in Westford, Massachusetts, wrote that as a pass-through entity, we pass through $1 million, but that doesn't mean we keep it for ourselves. We still pay out of that long-term debt, mortgages, truck leases, etc. We don't take it home. When all is said and done, we take home less than $400,000. By taxing us on everything over $400,000 assumes we are keeping that money for personal consumption, and that is just not true. I recommend rethinking this 3.8% small business surtax on small businesses who are hanging on with all the issues they've had to deal with over the past 2.5 years. In conclusion, small businesses continue to face economic headwinds. Congress can help mitigate economic challenges by extending beneficial small business tax provisions, reducing paperwork, and rejecting tax increases on small businesses. Tax certainty will help businesses plan for the future and increase small business confidence. I appreciate your time and attention to these concerns. Thank you for this opportunity.
Thank you, Mr. Kuhlman. We now yield 5 minutes to Dr. Mazer. You know, I asked that question and I still couldn't get it right, so I apologize.
Boyle, members of the committee, thank you very much for having me here today to discuss this important topic concerning the federal tax code. The federal tax code administered by the Internal Revenue Service is responsible for raising $4.5 trillion a year that pays for all the goods and services provided by the federal government. Just to review some basics, when we think about any tax system, there are 4 main criteria we use to evaluate it. 1, revenue adequacy. Does it raise enough revenue to pay for the goods and services that are demanded by the population? 2, efficiency. Is the revenue raised in a way that minimizes distortions? And distortions accompany any tax system, so minimize them in that context. 3rd, is it equitable? That means 2 things. 1, are similarly situated taxpayers treated roughly the same, horizontal equity, and are taxpayers with greater ability to pay asked to contribute a larger share of their resources than those with less ability to pay, vertical equity. And finally, simplicity. Where taxpayers know what their obligations are, know what the rules are, and can comply with the system without too much burden. Those are the ideals. Obviously, our system falls short on all 4 dimensions. All right, we can talk about revenue adequacy to start. In the late 1990s, early 2000s, last time the federal budget was balanced, the federal government raised about 20% of GDP in terms of revenues. Since then, as a country, we've decided to increase spending on things like national defense. And demographically, we have way more retirees than we used to have who claim benefits from Social Security, Medicare, Medicaid, and so on. And so if we're serious about balancing the budget, we'd be looking at something above 20% of GDP, not below. Last year, we had a one-time aberration to get up to 19.6% GDP. That would be a good start if we were able to maintain that. And so but that would take some action from Congress to actually raise revenues relative to the baseline in order to do that. In my testimony, I just do a quick little example of my personal situation. So in 1988, I looked at my effective tax rate. It was 21%. In 2018, 30 years later, my adjusted gross income was about 50% higher in inflation-adjusted terms. My effective tax rate was 19%. It was actually lower. So I was paying less to the federal government for the services I was getting, which are roughly the same level of services 30 years later, even though my income was substantially higher. Why is that? Because we've had a series of tax cuts that have occurred over a long period of time. In 2001, 2003, they were extended again in 2012, in 2017, and several other times. And those outweighed the tax increases in 1993 and with the Affordable Care Act. And so really, we're asking people, relatively well-off people, to pay less than they used to pay to support the federal government. That doesn't seem like a strategy for getting the budget balanced. I know the hearing today is focused on tax incentives. Largely, one of the things that you should keep in mind is almost all the tax incentives we have in place are inefficient. that they are not the most cost-effective way to generate the behavior that Congress is trying to generate. What we do with a current set of tax incentives is largely pay taxpayers to do what they would have done anyway. And so just one example, bonus depreciation, which I know my colleagues here like. Basically, bonus depreciation says if you're investing in your business to maintain it and keep it profitable and so on, completely deduct the cost of those investments, you would have done that anyway. We're not encouraging people to do much more than they would have done. Similarly, I talk a little bit in my testimony about things like 529 plans, which basically have people shift investments from taxable accounts into tax-favored accounts. Really doesn't change their behavior very much, but it does cost federal government revenue. And so if we're looking about designing tax incentives, what we would focus on is where the behavior occurs, and then try very hard to focus attention on changing that behavior in a very cost-effective way. And as Kyle Parmelo said, one of the things that we would certainly not do is do retroactive tax cuts, because frankly, that behavior has already occurred in the past. We're not changing it by changing the tax law with that. So really, you'd want to at a minimum, not do those things that will not change behavior. And with that, I'll just conclude here. Thank you for the opportunity to be here. Happy to take your questions.
Thank you, Dr. Mazur. We'll now begin our question and answer session. I'll yield myself 5 minutes. Let me start with you, Dr. Mazur. I think your comments were very thoughtful. I want to know, as a tax policy expert, is there a point at which, because you mentioned some of the tax incentives don't have the return on investment that some would say they do, but where is the point at which you have diminishing returns? And is there a point at which you tax either businesses or individuals where you get less revenue because you have reduced investment, growth, et cetera? Is there such an inflection point in your mind?
Well, for sure, you've heard of the Laffer curve, right? You've seen that picture drawn. So surely at 100%, that's not giving you much incentive, right? And so as you move back a little bit from that, you are able to generate additional revenue. But where we're looking at in today's world, with tax rates of between 20, 30, 40%, that is not even close to where an inflection point occurs. We're really far away. I think when President Kennedy talked about cutting tax rates, maybe we were close to it then, but really we're not there now.
I don't have, I'm not an expert on tax policy, but I am on the tax subcommittee on Ways and Means, and I've pondered what is the right rate for many years now. And I'm not dogmatic. It's not theology for me. But practically speaking, you look at our competitors around the globe and you say to yourself, do we want to be the highest taxed business job creators in the world, or do we want to be the most competitive or somewhere in between? Because capital is going to flow in this global market to the most, to where it's going to get the best return. And I think about pre-TCJA and how much capital was overseas, and how uncompetitive we were from a tax code standpoint. So you touched on this, Mr. Pomerleau, about bringing us in line. Let's just say, nobody knows the magic rate, but we know our rates relative to our competitors. And you said that if we implement President Biden's tax rates that he proposes in his budget, number one, it's about almost $5 trillion in new taxes. But you said it would bring us to the top taxed corporate rate or business rate in the OECD field, with the exception of one country. Who's the one country that would be taxing higher than the United States in that scenario?
Actually, a small country, Colombia.
Colombia. Who's in the top 5 with the United States in that scenario where we would increase the corporate rates to 28%?
So the countries that would be up there with us would be some of the larger countries like Germany, France, Japan.
I read from a progressive, more liberal tax policy think tank where corporate rates, the majority of corporate rate increases are passed on to consumers. is as high as 70%, that we can debate that, but are corporate rate increases passed to consumers in lower wages and higher prices, and to what extent does that dynamic occur?
Yeah, this is a complex issue, and it also depends on what the base of your tax looks like, how much it distorts investment, but it's generally true that any tax is going to fall on either workers or owners of companies, and a corporate tax is no exception. But the exact share really depends.
But
Go ahead, yeah.
the Treasury Department and Joint Tax Committee who studied this basically show that 70 or 80% goes to capital.
Goes to what?
Capital, not labor, not consumers.
One reason for that, by the way, is because the base of the corporate tax has a lot of expensing, which makes the corporate tax more neutral and less distortive for corporate investment.
Mr. McBride, talked about the progressivity of the tax code, and many would say it's the most progressive of the OECD countries. Did the TCJA make the tax code less progressive or more progressive?
A couple of studies on this indicate that it was basically a wash or made it slightly more progressive, actually.
Okay, so it wasn't less progressive.
No. Certainly demonstrably, when CBO looked at it, there were tax cuts across the entire income scale.
And we've heard this tired talking point about it was a giveaway to the rich, but my understanding is that lower income and middle income folks benefited as a percentage more than the higher income in terms of retained income, retained earnings. Is that correct?
I believe that's correct, but I'm not entirely sure. I don't have the numbers in front of me here.
Well, my time's expired, and I yield to my ranking member for his Q&A.
So on the TCJA, Dr. Mazur, you may know this, but am I correct when I recall that the Congressional Budget Office found that by 2026, 83% of the tax cut from the TCJA went to the wealthiest 1%?
Not aware of the actual numbers, but I do know that the benefits tended to go to higher income people, especially when you consider the corporate benefits going to capital.
And not just the richest 1%, but the richest 1/10 of 1% received a majority of the tax cut in the TCJA. Now, for most of this year, actually all of this year up until a few weeks ago, the major issue in the Capitol was the debt ceiling and whether or not it would be raised, whether or not the United States would suffer a first ever default. The alleged driver for those who didn't want to raise the debt limit was to win cuts because they were so concerned about the size of the national debt. Well, here we are, just last week, the House Ways and Means Committee passed a piece of legislation that would extend the TCJA, the GOP tax scam, and extend those tax cuts. Are you aware, perhaps, of how much that would cost in terms of adding to our national debt?
Tens or perhaps hundreds of billions of dollars.
Yeah, I believe over $2 trillion is what was found. Sorry, I'm not attempting to put you on the spot.
No,
I know that
depends how long you do the extension.
extension for it, that's correct, yeah. So I believe this was an extension that would cover 10 years or so, or at least make them permanent as far as the budget window. So, I mean, it's remarkable to me that the majority for months and months and months was talking about national debt, national debt, national debt. And then as soon as the debt ceiling is raised, they immediately pivot to making tax cuts for the richest 1% permanent that would add trillions of dollars to our national debt. It certainly calls into question the extent to which some are really concerned about our national debt. Now, you had, I think an interesting point in your written testimony, and you talked about it just kind of orally here. The level of taxation that you were paying decades ago, same individual, right? Relatively, I think, same income.
Same house.
Not deprived, but that was what I read. And just how much less you're paying now versus decades ago, and looking at that in relation to our deficit and debt issue. And I was wondering if you could just kind of expound on that, because I thought it was Very interesting.
Sure. So I'm a pack rat, and I do keep my old taxes, and probably some of you older people do as well. I looked, when I did my 2018 tax return, was after the Tax Cuts and Jobs Act, and looked at what my effective tax rate was, taxes paid over adjusted gross income, and it was 19%. And I compared it to what it was in 1988. Roughly same household composition, but my income in 2018 was like 50% higher in inflation-adjusted terms. And my tax rate was 2 percentage points lower, my effective tax rate 2 percentage points lower. And so I guess what I took away from that was I'm benefiting at least as much from the federal government now as I did 30 years ago in terms of public goods that have been provided, and I'm paying less for it. And frankly, I could afford to pay more, right? There's no, I'm not near the poverty level or anything like that. So, and so really, I think what it showed is just as a country, we've kind of shirked our responsibilities for ensuring that we're paying for the goods and services that our nation demands.
And to be clear, it's just reclaiming my time, because this was something else that needed to be corrected. And we have two sides of this, obviously, the corporate income tax side and the personal income tax side. Personal income tax side, our top marginal rate, 37%, significantly lower than where it was in the 40s, 50s, 60s, 70s. Brief period in the 80s, it was a little bit lower, but for most of Reagan's presidency, it was higher. And then, of course, Clinton, when he came in, raised the top marginal tax rate, and what followed was a remarkable period of economic growth for most Americans, as well as our stock market and reduction in poverty. Now, on the corporate side, in the 15 seconds I have left, the TCJA, of course, lowered the top tax rate, nominal rate, from 35% to 21%. Compared to what CBO predicted we would be getting in corporate tax revenues before the TCJA versus what happened afterwards, $100 billion shortfall, $119 billion shortfall the year after the TCJA took effect, another $100 billion shortfall, $160 billion shortfall. Those were all in the next 3 years. Again, according not to my figures, but the nonpartisan Congressional Budget Office. So there is no question that the so-called Tax Cuts and Jobs Act was a massive tax reduction for corporations and the richest 1%. With that, I yield back.
Thank you, Mr. Boyle. We'll now give 5 minutes to the gentleman from California, Mr. McClintock.
Thank you, Mr. Chairman. The ranking member's view of the Trump tax cuts reminds me of the story of the economist who said, well, that might work in practice, but it'll never work in theory. My Democratic colleagues seem to believe that taxes are simply a cash box with a dial. Turn it up, they produce more revenue. Turn it down, it produces less. But Mr. Mazur touched on this, the Laffer curve, which explains why that view is so wrong. A 0% tax rate, of course, produces zero revenues, but so does a 100% tax rate produce zero revenues because it utterly destroys the incentive to produce. So as the tax rate rises, the incentives to produce new wealth slowly diminish, and the incentives to avoid or evade the tax slowly increase at the same time until the curves reach a point of equilibrium in which any increase in tax rates actually produces lower tax revenues. Mr. McBride, do I have that right?
That's correct. That's certainly a real thing.
And history teaches us very clearly that this is the case. In the last 60 years, the top income tax rate has been as high as 91%, and it's been as low as 28%. But federal tax revenues have stayed remarkably steady at between 13% and 20% of GDP. And indeed, some of the lowest tax revenues came when the top tax rate was at its highest, and some of the highest revenues came when the top tax rate was quite low. But although the tax rates within this envelope has remarkably little effect on revenues, I do think that it has a big impact on economic growth, and experience, practice, tells us that that's the case as well. We keep hearing that the Trump tax cuts favored the wealthy. Well, Mr. McBride, you're tax foundation, right?
Correct.
Didn't you folks report that the taxes paid by the top 1% went up, while the other 99% of Americans saw their taxes go down with the Trump tax cuts?
The share of taxes paid by the top 1%, yes, reached, I believe, at least a 20-year high.
The top 1% actually saw their share rise from 38% to 40%, correct?
Correct.
And the top 1% of taxpayers, they earned 19% of all income in the country, and yet they ended up paying 40% of all of the income tax revenues. Do I have that right?
That's right.
So when they say the wealthy ought to pay their fair share, what they're really arguing for is to cut their taxes in half. Do I have that right?
Sounds right, yes.
Mr. McGregor, when we cut taxes during the Trump administration, did tax revenues go up or go down?
They certainly went up, and they went up beyond expectations.
But the deficit also went up. Why was that?
Spending went up
Even faster, right? It's
much more, yes. It
I've been
remains
trying to point out to my
considerably
friends
higher.
on the other side, it's the spending stupid. And that's the point. Deficits are simply a deferred tax. We borrow now, and then we have to pay it back in the future, or we simply inflate the economy, and everybody pays it back at the grocery store and the gas station, and this administration has made a science of both of those. When Reagan cut taxes, did tax revenues go up or go down?
They went up eventually.
Yeah. Well, eventually, because the tax cut was postponed for 2 years. And as Art Laffer had explained to President Reagan at the time, Mr. President, how much shopping do you do at a store the day before they have their year-end sale? But the point is the economy responds to these things. And the Democrats used to understand that. When Truman took office, he abolished the excess profits tax. He slashed federal income tax rates. And we had the post-war economic boom. The ranking member's right. Clinton did raise taxes shortly after taking office. And he took such a drubbing at the polls, they lost the congressional majority. He completely reversed course, came to the Congress and declared the era of big government is over. And what did he do? He provided what amounted to the biggest capital gains tax cut in American history. He restrained federal spending, actually reduced federal spending as a percentage of GDP. And we had explosive economic growth in 4 years of balanced budgets. You would think that with that practice in hand, the left would abandon their socialist theories, which have never worked here or anywhere else they've been tried. I see my time's up. I yield back.
I thank the gentleman from California and yield 5 minutes to my friend, Mr. Higgins from New York.
Thank you, Mr. Chairman. Just a couple of things. You know, America remains the world's richest, most dynamic and productive economy. It's the largest economy. It's 25% of the world's economy. It's a $24.5 trillion economy. America was 40% of the world's 7 largest economies in 1998. Today, it's 58%, or 18% increase. America is home to 11 of the top 15 universities in the world. Tech investment raised $150 billion, or 49% of the global total, and more than double that of China. In the United States today, as the ranking member has said, that the U.S. recovered from the coronavirus pandemic faster than any major economy in the world. Unemployment is at a stunning low, 3.4%. Biden's economy grew 3 times the average pace of the previous economy. Real incomes are rising. Manufacturing is booming with 800,000 new jobs. Employment has grown under this administration by 14 million jobs. Even inflation, which this month was at 4.1%, is lower than the global average of 5.2% and 2 percentage points lower than the average inflation in Europe. Even the budget deficit, 15.6% of the economy at the end of the Trump administration, has dropped to 5.5% at the end of last year. Now, I was just looking at the last 34 years. You've had 3 Republican administrations and you've had 4 Democratic administrations. We've had 4 recessions and 4 recoveries. Under George H.W. Bush, Bush 1, the deficit grew by $300 billion and drove the economy into recession. Under the Clinton administration, he fixed the broken Bush economy and grew the economy by 4% each year, sustained over an 8-year period, paid $400 billion in debt reduction, and left Bush 2, George W. Bush, with a $260 billion surplus. Bush 2 took the Clinton surplus and turned it into a $1.2 trillion deficit and drove the economy into its worst recession since the Great Depression in 2008. Bush cut Obama came in, cut the Bush deficit by $600 billion. Trump increased the deficit by nearly $2 trillion, lost 3 million jobs, including 200,000 manufacturing jobs, and accumulated $8 trillion in debt, which necessitated the raising of the debt ceiling 3 times. Biden created 14 million jobs. I mean, there's a trend here, and each of these administrations that failed economically adopted a supply-side economic policy that disproportionately gave tax cuts to the very wealthy, and each time those economies have failed miserably and then were saved by the Democratic administrations that came in and invested in the growth of the American economy, and that's what the economy did under those administrations. Mr. Mazur, what am I missing here, sir?
That we all tend to do is overstate the role of the tax system in what's going on in the U.S. economy. It's a contributor, but it's not the driving force. The U.S. is a very strong economy. As you point out, 4% of the population, 25% of the world's economic output. That means we're in a position where we have lots of strengths. Well, good labor force, good capital markets, good rule of law, supportive federal government, supportive rules, and so on. So the tax system is just part of the process. I guess I might quibble a little bit with assigning blame to each of these administrations or credit. It is true that the economic policies of the Democratic administrations tended to raise taxes and put you in a better fiscal position. That part is true. But whether...
Does infrastructure investment grow the economy?
Yeah, I think that one of the major benefits of the infrastructure bill that was passed is it allows there to be high rates of return investment in every state of the country.
Because that is an investment in the growth and the productivity of the American economy. Tax cuts that end up as stock buybacks do not contribute to the growth of the economy. And what I'm simply pointing out here is that there is a trend that is historical and factual. Sir.
Gentleman's time has expired. Mr. Estes.
Well, thank you, Mr. Acting Chairman. I appreciate the opportunity. Thank you to our witnesses for being here today. I'm glad we're having this hearing today. Talked a lot about last week's CPI numbers and confirmed that the American economy does need help to be reignited. The Kansans I represent are still suffering under Bidenflation, and tax policy lays an important foundation for helping economic growth for everyday Americans. You know, families and small businesses have suffered for more than 2 years under the failings in this economic policies of the Biden administration. Inflation's up 5.5% since Joe Biden took office in January of 2021, much higher than any of his predecessors over the same period of time. And instead of addressing this issue, the president in his budget proposed $4.7 trillion in tax increases at a time when Kansans are already paying 14 cents out of every dollar they earn in direct federal taxes, not including the taxes they have to pay through the purchases of businesses that ultimately pay taxes from the income from Kansans. You know, this is opposite of incentivizing economic growth if we want to increase that amount. I mean, I do have a couple of ideas about tax policy that the president could put in place to make that important, and I want to talk about that a little bit. But one of the things I want to at least touch on that was brought up earlier, and you know, talking about the difference between in theory versus in practice. You know, the Tax Cuts and Jobs Act that was passed in 2017 obviously is sort of like an investment that you might make in a business, is that you change the tax code to make sure that you incentivize the behavior you want. And as a result, we've seen the economy take off and grow. So the first few years, you may have lower tax revenue, as mentioned by my friend, the ranking member. For the first couple of years, first 3 years, that went into place, that tax revenue was down over prior years. But the last 2 years, we've already seen we've turned the corner. That investment from the Tax Cuts and Jobs Act raised over $200 billion more than the CBO estimated in 2021, and in 2022 raised over $900 billion in actual tax receipts, more than what the CBO had estimated. So obviously, we're seeing some positive results out of that by making sure the economy keeps going. So I mentioned there's a couple bills that the president could consider to help get the economy going. One's a bipartisan bill, the American Innovation and R&D Competitiveness Act, that restores immediate expensing for research and development cost. This legislation was part of the larger tax cut and economic growth package that we passed through Ways and Means last week, the Build It in America Act, and we reported out, has already been reported out of committee. It's a promising start. I mean, it'll change our tax code to help generate innovation and foster job growth so that we don't cede any more ground to our adversaries. You know, just as a point of reference, our main competitor, China, has seen its R&D investments increase 400% in just 2 decades. While the United States share of global R&D investment in 2019 was 30%, China's was 24%. You know, that's a far cry from where we were in 1999 when the U.S. was at 40% and China was at 9%. So obviously, we've seen a huge growth making those smart investments. Mr. Coleman, will restoring R&D expensing reduce the tax burden on new investments, and how that helps for economic growth?
Yeah, I think, yes, Congressman, it will. It's especially a big deal when cash flow is tight and as interest rates are increasing. That is certainly the case. I've been hearing, particularly from manufacturers, engineering firms, architecture firms, technology companies, that it certainly would be helpful.
Well, thank you. And a second thing we need to do, talking about tax policy, we need to focus on what's being bantered about by the Biden administration on the OECD Pillar 2 tax scheme that the administration's been pursuing. Basically, what their proposal is that the OECD would dictate what U.S. companies pay as a tax rate on operations inside the United States, and actually would be detrimental to U.S. tax receipts. So according to Joint Committee on Taxation, if this global implementation of the global minimum tax as defined in Pillar 2 is implemented, the United States will lose $120 billion in tax revenue that'll be lost. And even if the United States changes its tax code to match and to copy what the rest of the world does, we'd still lose $58 billion in tax revenue. So businesses are going to lose money, and we're going to get less tax revenue in the United States. That's just a poor policy, and we need to make sure we don't proceed down that route. So I know I could go on for a lot longer, but I'm out of time, and I'll yield back, Mr. Chairman.
Mr. Blumenauer.
Am I next? Oh, Earl, you're next.
Thank you, Mr. Chairman. I hesitate to contradict my ranking member, but there were actually
Ms. Schakowsky is now recognized.
more Democrats who voted for the NAFTA revision than Republicans. Just keep the record straight. But I do appreciate you and Mr. Higgins laying out what the facts are regarding whether or not somehow the economy is some sort of rapid decline as a result of 29 months of the Biden administration. There have, in fact, been more jobs created, 13 million additional jobs compared to the miserable experience that we had under the 4 years of the previous president. Those are facts that can be verified. We have 28 consecutive months of job growth under the failed policies of President Biden. Doesn't seem to make sense. We are at historic low record of unemployment. And for Black Americans, it is an all-time record. Hardly the characteristics of failed policies. To the contrary, in terms of growth, in terms of jobs, those are examples of where it is in fact working. And as have been pointed out here before this panel, problems of inflation are not unique to the United States, but in fact, the record of the United States is that we have done a better job of dealing with inflation than the other major economies around the world. I mean, again, Germany, France, Italy, United Kingdom have experienced far more unemployment than inflation than we have. And I would suggest that it's important to try and put this, we can go ahead on our rhetorical flourishes and talk about theories about what would work or what not, and make rhetorical attacks based on socialist policies and communism and other delusional theories. But the fact is, our democracy and its economy are doing better than any other major economy in the world. And it's time that we'll be able to reflect on the performance of the Biden administration. It seems to me, as we're talking about taxation and generating revenues, I am saddened to say that my colleagues, when they got their hands on the levers of power and be able to advance policies, one of the first policies they advance would increase the deficit by slashing enforcement of our taxes. Now, we can debate about what the right level is and who should pay it, but I think it is unconvertible that people should pay the taxes they owe now under the existing system. And those of you who purport to represent small business, I would think that you would want to make sure that they are protected by making sure that people who owe taxes pay what they are responsible for doing. That should not be an item of contention. The lowest and less, the tax system that has the least friction is collecting the taxes that are already due and are not being paid. And sadly, the evidence is the further up the food chain you get, the richer you are, the larger the corporations, they have less compliance, not more. We ought to embrace those investments to inject a sense of fairness so that they are not disadvantaged by people who cheat. That is not in anybody's interest. Finally, it seems to me that the recent proposal from my Republican colleagues to gut the inflation reduction proposals to incent investments in alternative energy, which are working. There are billions of dollars that are being committed, largely in red states, to take advantage of those provisions. And it's sad that the majority wants to strip those out of the tax code. Mercifully, they won't be successful, and they shouldn't be, because they're working for the American people. Thank you, and I yield back.
Mr. Bergman.
Thank you, Mr. Chairman. I find it interesting that too many of us in our 435-member body spend the 5 minutes of valuable oxygen consumption time talking rather than listening. But it is what it is. We all run every 2 years, and we have to figure out a way to get back here. So let's talk to the folks that are sitting somewhere in a mom and pop restaurant today or in a machine shop that maybe employs 4 or 5 folks. And so if they were listening to this, it's on their lunch break, and all their employees are listening, how much of what has been said here today do you think they would understand as it relates to their daily lives? And are we, whether it be us here on the dais or you at the table, are you actually
not necessarily thinking in terms that they will understand, but utilizing examples that small mom and pop business understands. Anybody want to offer comment? Are we in our own little bubble here as we have these high-level philosophical, a lot of cases, non-decision-making discussions? Anybody want to offer comment?
Congressman Bergman, thank you. We, just last week, there were about 200 NFIB, small business owner members in town, met with many offices, including yours and you. So thank you for meeting with them. But we just encourage them to tell their story, share their story about it. We follow it at a macro level, but we always think the individual stories are much more important. And it was, how tax relief was reinvested back into the people and into their production and not into their.
Have we, as the federal government, made it too complicated?
Yes, and they do acknowledge that things are very.
So the point is, if we've made it too complicated, if we looked at, and when we talk about corporate taxes, or we talk about taxing the wealthy, which is, I think if I remember in my first term in budget 7 years ago, the math was said if you taxed the wealthiest 1%, 115% of their income, which would seem a little weird, that it still didn't even come close to beginning to reducing the national debt. The numbers don't match. It's a nice soundbite to play, but the math doesn't work. So I'd like to hear from whoever wants to offer comment on the following statement. If we eliminated, was it a fair statement to say that corporate income tax is very simply passed along to the end to the consumer? If I'm a business and I pay corporate tax and I do my structure and I do what my market forces will allow me to do as a business, is it fair to say that corporate taxes are passed, those expenses and paying the corporate taxes eventually passed along to the consumer?
Yes, and especially in an environment now where businesses have become as efficient and productive as they possibly can. They're dealing with stubbornly high inflation. Certainly the costs do have to be.
So the point is it time that should we just consider getting rid of the corporate income tax because the consumer pays it anyway? And if you're a corporate executive making $20 million a year, you just pay that tax on it and that revenue comes direct to the government?
The literature shows, and we talked about this
wrote
a
the
moment
literature?
ago, from Treasury, Joint Tax Committee, Congressional Budget Office, shows that about 80% of the corporate income tax is borne by capital. So shareholders generally pay for that, not consumers. Now, the other 20%, 30% is borne by labor and consumers. So there's a portion of it. But the
Okay, so
largest
when you said borne by capital.
yeah, the shareholders.
Okay, so the point is, in the long term, if we're trying to create an economy that is streamlined so that people working, whether you're the business owner or just that employee there working there and paying your personal income tax, that you can live the kind of life that your grandparents had hoped for when they were struggling through the 30s and 40s. And I see my time has run out, so I guess we'll have to take that for another time. But I will always defer to Mr. McClintock because of his ability to take these complex things and break them down for folks like
As
me.
much as it pains me to interrupt the gentleman in such a compliment, the gentleman's time's expired. Ms. Ballant. Ms. Ballant.
Thank you, Mr. Chair. Thank you all for being here today. Talk about these issues. They're very important to me. I come to this hearing as a teacher from Vermont who's worked in 4 different rural public schools and have really direct experience with dealing with rural poverty. And right now, 1 in 18 Americans live in what writer Matthew Desmond has called deep poverty, 1 in 18. He said it's so low, he refers to it as subterranean level of scarcity. And rates of poverty in this country have really not changed since the 1970s. And today, a minimum wage full-time worker cannot afford a two-bedroom apartment anywhere in America. Anywhere. So in all of our districts. And this obviously should trouble all of us, that people are working as hard as they possibly can. And they, we can talk about investments, we can talk about stocks, we can talk about, who's better off. I can tell you, most folks are not better off right now. Dr. Mazur, as you know, for decades, the Republican Party has carried out essentially the same playbook of cutting taxes for the rich and then feigning concern over the deficit. We just went through this. It's really fresh in our minds. And then proposing spending cuts to vital programs such as Social Security and Medicare. And I know my colleagues are also teeing up part 2 of the Trump tax cuts when we haven't even been able to pay for the first phase. First phase cost us a whopping $1.9 trillion and has led to a proliferation of billionaires in the United States. And in 2018, for the first time ever in our country's history, the richest class of Americans paid a lower tax rate than working Americans, and the average effective tax rate of the top 0.1% of households dropped by 2.5 percentage points. Their greatest legislative achievement did nothing to address the unbelievable wealth inequality in this country. And according to April data from Forbes, the United States now has 735 billionaires, the highest number of billionaires in the world, who consistently use our tax code to the maximum advantage at the expense of American working families, like the Vermonters in my district. And just this week, we learned that one of these billionaires may be exerting influence over the Supreme Court. According to ProPublica, hedge fund billionaire Paul Singer spent some of his vast fortune to take Justice Samuel Alito on a luxury fishing trip. And he repeatedly had cases concerning his company in front of the Supreme Court. Now, I'm a daughter of an immigrant, and my parents, like so many others, sought to achieve the American dream here. However, the current American tax code has rendered the American dream basically unattainable for most people. Dr. Mazur, it's difficult for many of us to imagine it, but what would a more equitable tax structure look like today? What's possible?
So a couple things are possible, I guess. One is that you could rebalance the tax code so that higher income people pay a larger share of their income for taxes. And that could be either through payroll taxes for Social Security or Medicare, or through income taxes. You could look at the preferential rate on capital gains and dividends. There's a lower rate put on dividends that was supposed to account for the 35% corporate tax rate. It did not get changed when the corporate tax rate went to 21%. You could imagine changing that.
Can you unpack that a little bit more for people? Because I think it's really important.
Sure. So Congress passed a lower tax rate on dividend income back when the corporate tax rate was higher than it is today. And part of the reason was, stated reason, was that, well, corporations already pay a high rate of tax. You're being double taxed on this dividend as it comes through. But when the corporate tax rate was dropped, the preferential rate wasn't changed at all. So you kind of get a double benefit from that. So those are just a few things. One point that you made that I think deserves emphasis is looking at the minimum wage.
Yeah.
We have not increased the minimum wage in the United States in decades.
It's disgusting, is what it is. It's disgusting.
Yeah, and you're right that you can't afford to live on a minimum wage job.
No. You can work 40 hours a week in this country, making minimum wage, and not be able to afford housing, basic housing, not great housing, basic housing for your family. This should not be happening, and we should not be letting it happen. So I yield back.
Generally yields back. Mr. Ferguson.
Thank you, Mr. Chairman, and thank you all for being here today. So I just want to go through a couple of things here that just kind of make my brain hurt a little bit. We've got my colleagues on the other side of the aisle are screaming about corporate America paying their fair share, okay? If we, whatever that number is, okay? Because of the Inflation Reduction Act and the infrastructure plan, there have been over $1 trillion worth of tax credits made available to corporate America, right? So the very people that my colleagues on the other side of the aisle say they want to pay higher taxes, the wealthiest corporations and the wealthiest individuals can now buy these tax credits and their effective rate becomes zero. Correct?
That's correct, yeah. That's,
All right, so we're screaming about corporate America paying more taxes, and yet we're going to turn around and give them what it now is about a $1.2 trillion tax credit to offset the tax rates. So we're going to raise you, but we're going to allow you to pay zero. I just want to make sure I'm right on that, right?
that's absolutely correct.
Okay,
It's
all right,
called-
got that.
It's called
Number two.
subsidizing and penalizing at the same time.
Exactly. So that's number one. Number two, Pillar 2, OECD. That is going to remove $300+ billion from the revenue stream if that goes through. $300 billion. So now we're telling corporate America we want you to pay more and higher taxes, but we're going to give you a $1.2 trillion offset. And then, by the way, we're going to give about $300 billion of our taxing authority away to other countries. Now, that to me just is a really bad policy. And then I hear my colleagues talking about raising tax rate, lowering tax rate, doing it with Clinton, doing it after Clinton, before Clinton. We need to recognize that we are in a global economy and we need to be doing everything that we can with our economy to make America the best place in the world to invest, create jobs, and sell around the world, period. So we can have a lot of discussions over spending where things should go, but the unifying philosophy for this body should be, are the decisions that we're making make America more competitive or less competitive? Do they create more jobs? Do they take away more jobs? Are we doing more to invest in research and development and come up with new ideas, or are we trading that away to other parts of the world? So when we look at all of this debate about revenue and spending, I raise the corporate rate 10%, raise the individual rate to 40%. These folks are going to take advantage of the refundable credits and make their effective tax rate zero. So how in the heck does that make sense? I mean,
It doesn't
feel free,
make a lot of
Mr.
sense.
McBride.
I agree. The major outcome of that approach is complication, further complication of the tax code. So lots of measures of how complex the tax code is, but one is the number of words, about 4 million words and counting.
All right, so if for folks that have not lived in an area or that currently do live in an area without a manufacturing base, okay? It is incredibly difficult to sustain a community or a county or a state unless you have manufacturing there, okay? I mean, it just is. And when I say manufacturing, a major job creator that is the economic backbone of a county or a city or a region. That is what feeds off all of the other small jobs and small businesses that we see growing in a community. So if we raise the corporate tax rate, okay, and we do not get away, and we don't move off the snide on this trade policy that we've got, we're falling further behind. And by the way, we're going to see less tax revenue coming in because we're giving people refundable credits and we're giving away part of our taxing authority to the tune of about $300 billion. And by the way, what does that do? Does that do anything for American competitiveness and job creation? Mr. McBride, I'll let you answer that question.
And no, what it does is you could say level the playing field, but levels the playing field across the world with a higher level of corporate taxes, which
But
dozens
wait,
of
but I mean,
studies
all right,
show
so
are
level it with
detrimental to
higher, but
economic
level
growth.
it with higher taxes. But our biggest corporations aren't going to be paying taxes because they're going to use the refundable credits.
That's
from
right.
their
So what we're getting is a high marginal rate that applies generally, combined with a bunch of preferences for specific companies, industries, and taxpayers.
Time has expired, but thank you for helping me expose the hypocrisy of this conversation. Thank you. Yield back.
Ms. Schakowsky.
Thank you. So, this committee comes up with very interesting titles. The second part of the title of today's hearing is Incentivizing Economic Excellence Through Tax Policy. But I would think that's more accurate as saying what we have right now is incentivizing economic inequality through tax policy. And, we are the richest country in the world, except that we are also, I think, number one in the world of industrialized nations of the unequal distribution of that wealth right now. There are 3 American families. It's Bezos and let's see, what are the 3? Musk? No, it isn't Musk. It's Buffett and who is the third? Okay, anyway, 3 American families, that I want to take my own time, that has as much wealth as the bottom half of Americans. Think about that. And you heard, I thought, a really good explanation and examples of how this has affected Americans in our country. And so it just seems to me that we need to focus, if we're really concerned about not just equity. And let me ask you, Secretary Mazur, you mentioned what it takes to have, and I don't want to blame everything on tax policy, but you did say that you thought that people that have the most ought to pay more. How would you justify this to some people in this room?
Criteria of good tax policy is vertical equity. And what vertical equity means is higher income people pay a larger share of their income than lower income people. That's reflected in a progressive tax rate schedule, but there could be other ways to do that as well. And it really is just a basic sense of fairness, that those who get the most from the system should sort of pay the most for maintaining that system.
So right now, what we are seeing is that the Republicans are coming up, as you have heard, of a proposal of a major tax cut. It looks like it will also go to the wealthiest Americans, and at the same time, talking about paying for it through things like that have been suggested, cutting Social Security, raising the age to now 59 is the proposal by the majority of the Republicans right now, and looking at so-called entitlements, which of course people pay for through every paycheck. And is this, in your view, as someone who deals with the economy, going to make our economy stronger? These choices of lowering the tax cuts, mostly to the wealthy, and cutting the benefits and the programs that help lower income people.
I mean, I think making the country stronger from a fiscal perspective requires 2 things. 1, more revenue, and 2, some brakes on spending. And I think Chairman Harrington talked about that as these are the 2 levers that you can move. And really, it's a matter of balance, getting that right. Our revenues today are too low to pay for the goods and services that we as a country demand. If we want to demand less, that's okay, but we still need to raise the revenues to pay for the ones that we demand that are out there. And you're right about some of the entitlements. People have paid into them with the understanding that they'll be there for them when they retire, Medicare and Social Security in particular. And so those are promises to future generations that we as a country need to redeem.
The other wealthiest person was let me see, they are, thank you, I appreciate that. Gates, Warren, and Buffett. But,
Ladies' time has
okay,
expired.
I yield back.
Mr. Moore.
We know it's not me, and probably anybody in this room.
Thank you.
I wish the chairman was here, because I don't like to give other people compliments on my birthday. I try to reserve those solely for myself, but I'll be remiss if I didn't just hit on the topic of credibility. It's a currency that is dwindling in this place of Congress, unfortunately. And I really appreciated his opening statements. To be able to stand in front of a sitting committee and fully state that he wishes his party, my party, and I share the sentiment, could have done more and would have done more about spending, overall spending, mandatory direct spending or discretionary spending across the board. Wished in 2017 when we had the majorities in the White House, or the White House, the House, and the Senate, wish we would have done more. And we would have had an even stronger argument, in my opinion, of what I think is a pretty strong argument with respect to the Tax Cut and Jobs Act, but I truly wish that would have been the case. And I appreciate his willingness to be, say he's somebody that has always led that way. He's inspired me. It's why I want to be close. I'm on both of the major committees that he's on, and it's a currency that we just don't have much of back here, and I've appreciated that from our chairman. And also, the minority witness, Mr. Mazur, you earlier said I would quibble or I would hesitate to just fully lay blame or cast the context that it's, laid out that it's this president did this president did this. I've heard it communicated oftentimes, sometimes the economy is what makes the president, actually. And, our economic cycles go in a certain way that sometimes you catch the tail end. I don't blame the entire 2008 financial crisis on President George Bush, no way, right? That has been policy that has gone on for years, neglect of a lot of different things with lots of players. So I appreciate, that concept of credibility. And I was back in Utah with my colleague from the 3rd District, John Curtis, Representative Curtis, and he actually put it better than I've ever heard anybody say it. And I'm going to talk about calling the tax scam, calling the Tax Cut and Jobs Act the tax scam for the rich. I'm going to just emphasize the way he communicated it. He said, "I've never seen it's uncanny to me that Democrats have an opportunity when they can communicate a message and stay on that point so much that ultimately the media and a large group of people will ultimately believe it. And we will stand up as Republicans and list out all this data. I'm going to do it again. List out all this data and all this good information that refutes that fact. And oftentimes my colleagues from the other side of the aisle, all they have to do sometimes is stand up and say, this is a tax cut for the rich. And literally, that's the narrative that continues on. I resent, and I would hope that we could actually agree that the child tax credit is not a tax scam. That real wage growth, because the Tax Cut and Jobs Act didn't create an enormous amount of inflation. It didn't create any. We were able to see real wage growth take place. You had a doubling of the standard deduction. Is that a direct benefit to the wealthy? In fact, I'll ask the question, Mr. Mazur even, asking the minority witness a question. Would you say that the standard deduction is a benefit to the wealthy? Would you also say that SALT, the way we address SALT, by saying what was the average across the country of state and local taxes and that deduction? Let's double it. And is that a benefit to the wealthy, what we did on SALT?
There are pros and cons to all these things, right? So if you take individual items, you can say they benefited high-income people or lower-income people. But Tax Cuts and Jobs Act had lots of moving parts.
Yeah, it's a very large piece of legislation.
And so when you
In
talk
fact,
about the SALT deduction, you also largely repealed the alternative minimum tax. And many people who feel that they lost the deduction for their state and local taxes actually lost it under prior law through the alternative minimum tax.
right. So don't disagree with any of that. And I'm trying to make the point here that so many provisions in the Tax Cut and Jobs Act weren't just this benefit to the wealthy. And I think it's a disingenuous narrative, but this place is what it is, I get it. And I would like to just, with my remaining time that I used way too much, focus on just one last thing. We have the R&D tax credit.
to Mr. McBride, the R&D tax credit. Can we look at that and say, this is something we've got to preserve and work together? Would you suggest that Congress try to work together on a bipartisan way to make this happen so we can make sure that we can write off these expenses in that first year?
Well, you mentioned R&D credit. I think you mean R&D expensing. That's the item.
R&D
that's
expenses,
now-
yes.
Has now expired, and we're now faced with the first time ever in this tax code we've had for 100 years, where businesses are required to wait for those deductions and suddenly figure out how to amortize R&D expenses, which are primarily labor expenses, about 70%. So this is, paying scientists and stuff like this.
Sadly, the gentleman's time has expired.
Appreciate it.
Even more sadly, they've called one of these pesky, annoying votes that just disrupt the schedule and are just very annoying, but there it is. It'll probably be about, I think there are 3 votes scheduled, so it'll probably be about 30, 35 minutes or so. So you all go out and get a cup of coffee or whatever, and apologize for that, but it's an occupational hazard of this job. We're all going to go vote. You go out to coffee, and we'll all come back in about a half hour. So thanks. Committee stands in recess.
We now have the requisite members of the committee from both sides of the aisle, so we're going to reconvene here. Committee will come to order. And now, Mr. Scott, I know you're getting yourself situated, so I don't want to start the clock on you. He's walking up here, ladies and gentlemen, to the upper deck. He is going to take full control of the ranking member's chair, and let's hope he doesn't drive us into the ditch like Brendan Boyles has done too many times. This is what you get as an open mic when everybody else is gone. Yeah, so feel free to pick on a few of my guys that aren't here.
Well, I'll pick on, thank you, Mr. Chairman.
Ranking Member Scott, the floor is yours. I yield 5 minutes for your questions and answers.
Thank you, Mr. Chairman. Well, I hope I don't put us in the ditch like every Republican president since Nixon has done. Every Republican administration since Nixon has left for their Democratic successors a worse deficit than they inherited. Every Democrat administration since Kennedy has left for their Republican successors a better deficit situation than they inherited. President Trump was on the way to doing that before the pandemic. President Biden is doing that already. So, let me see, Mr. Mazur, we've heard about inflation and blaming the president. How's the United States inflation rate compared to the rest of the world?
Generally, the U.S. inflation rate now is lower than other developed countries, like in Europe, for instance.
So we've got a global inflation problem, and we're actually doing better than most.
Relatively better, yep.
Mr. Mazur, do tax cuts affect the budget?
By arithmetic, yes, they affect the budget.
Well, some don't apparently believe in simple arithmetic like adding and subtracting, because you know that under PAYGO that Democrats have as a budget rule, if you have new spending, you have to pay for it with either new taxes or other spending cuts. Got to pay for it. If you have a tax cut, got to pay for it. Either raise somebody else's taxes or spending cuts to pay for it. Under the Republican plan, if you have a new spending plan, you have to pay for it. But if you have a tax cut, you don't have to pay for it. As if they didn't understand what you just said, that it's simple arithmetic. So, we've heard about taxing policy. Different tax cuts or different spending initiatives can stimulate the economy, but on a differential basis. Isn't it true that reducing taxes on dividends has a negligible effect as a stimulus to the economy?
Yeah, I would think that relative to other potential tax cuts, given who the owners of shares are, giving them a lower tax rate probably doesn't boost the economy that much, and probably doesn't change corporate behavior that much in terms of dividends paid.
And you said compared to other tax cuts, like what?
Well, if you're thinking you want to boost consumption, then you'd probably want to provide resources to people who are going to consume those tax cuts, so lower income, middle income people.
Like the child tax credit?
Child tax credit would be one example, and I think you saw when it was a refundable credit paid monthly, that it had a pretty substantial benefit to the recipient families.
And the earned income tax credit?
Earned income tax credit's similar, though one caveat on the earned income tax credit is that for many years, the earned income tax credit has been used as a replacement for increasing the minimum wage, largely saying, we're not going to increase the minimum wage, but we're going to give you a tax credit instead. That works for the people who are eligible for the tax credit, but not those who don't have qualifying children living in their household.
And certain spending would have the same thing, like if you increased unemployment benefits, that would have a very good stimulus, or food stamps, increase that. That would go right back into the economy.
Generally true.
So we know which tax policies work and which ones don't work. Who basically benefited from the 2017 Tax Cut and Jobs Act better known as the Trump tax scam.
So the Tax Cuts and Jobs Act that was passed in 2017 had lots of moving parts. Basically, 2/3 of people in the country probably got a tax cut. The tax benefits for corporations were generally permanent. The tax benefits for individuals were generally temporary. I think there was a slightly larger proportional benefit to higher income people, in part because they benefit from the corporate tax cuts.
Thank you, Mr. Chairman. I yield back.
I thank my new ranking member. And now yield 5 minutes to the gentleman from Wisconsin, Mr. Grothman.
I got 10 questions, so you got to answer quick. We didn't get all we wanted in our tax cut, or I didn't. And one of my concerns was, I thought the purpose of the tax cut was, to a degree, to make us more competitive with countries abroad. And there are segments of the population that are more important than other segments. Manufacturing was always treated special in this country through a special credit. That disappeared with the tax cut. We only have so much money to pay for tax cuts. Somebody didn't say we don't have enough money to pay for any more tax cuts. But do you have a problem if we target it at manufacturing, which has to compete with other countries abroad? And maybe if we have to target it even more, the machines that are used in a factory to make other machines. I tour my manufacturers all the time. There's always very important machines, printing, that sort of thing. Where do they make that machine? It's always Germany, Italy, Belgium, Korea, or Japan. Do you think there is a problem with targeting the tax cut to those manufacturers as opposed to, say, retail, which is going to be here anyway?
I'll take that one. I have a problem with that. I mean, I think targeting manufacturing is, first of all, not a very small target. Manufacturing is a huge sector. There was a manufacturing deduction years ago.
Before we got rid of it, it was a
That's
manufacturing
correct.
credit.
And it was taken by all sorts of taxpayers, including publishers, coffee makers, stuff like this. So manufacturing is just a huge sector. And the other thing is that I agree that they are subject to to competition from abroad. So are other sectors like information technology. There's lots of mobility in a lot of sectors.
Okay.
I suggest
I'm going to cut
generally
you off.
lowering the corporate
Yeah,
rate.
I'm going to cut you off a little bit. There is an economic argument, if you are solely concerned in the short term, that one business is the same as another business. I thought we saw a little in the COVID that there are some businesses that are more important for our national security and for our wealth, which is why I wondered about targeting manufacturing as opposed to retail, or say, law offices. Did any one of you want to comment on that at all? I mean, we used to treat manufacturing better.
Yeah, so it's possible that you could make an argument that for national security purposes, certain types of production should be in the United States. But I don't think that the tax code is a good tool to accomplish that. I think tax systems should be primarily used to raise revenue in a neutral manner. But if there are national security concerns, that should be dealt with elsewhere.
You can tell me how later, but, okay, next question we have. We are sometimes criticized for having our tax cuts favor the rich. That's inevitable, I think, because the poor don't pay any taxes in the first place. But I do think it would be good if, to a degree, we went after credits that purely are benefiting the wealthy. One of those is carried interest. Does anyone want to say that we should get rid of carried interest? You can do it if our guys won't.
No, you should. I think this is an area where basically it's ordinary compensation to people in various businesses, and it's treated in a preferential way.
Yeah, we're helping the hyper-wealthy with a different tax treatment. Well, thank you. Any of our guys agree with that? By our guys, I mean the left three.
I agree with Mark. I
Okay, well,
think that the treatment is under current law.
We'll try to do that. Now, I'll give you another one. Section 42, low-income housing. That is, you know, you're giving some guy or gal 85, 95% of the value of a new building if they rent to low-income people. It offends me out of my mind because you have this group of people who probably gives a lot of money up here too, who are getting wildly generous tax cuts. Maybe they sell these credits to other businesses. Do you feel that's something we should get rid of, or is that, I mean, just saying, you're just overwhelmingly benefit very wealthy developers. You want to comment on getting rid of that?
I mean, I think the important thing to recognize is that that is pretty much the only low-income housing project.
So you don't think we can, first of all, low-income housing isn't a federal problem. It's a state problem. But you don't think there's any way to get money for housing for poor people other than to, in essence, give very wealthy developers?
No, if you want to do it through a spending side program, it could be way more targeted, way better targeted than it is. But Congress has decided to do it through the tax code, and as Kyle has said, the tax code's a very blunt tool.
Any of the other guys, I hate Section 42 more than anything, that's why I bring it up. Will any one of you guys say it's wrong, it's not good to make the wealthiest of developers wildly more wealthy? That's the only way we can.
I say it's wrong. I mean, I think most of us probably would say that. It's wrong in the same way that targeting manufacturing with a special provision is wrong. I think the general principle is that the law should apply generally. And so this thing for low-income housing should go in favor of lowering rates generally for all taxpayers.
I guess I'm up. I can talk forever if you want me to.
No, well,
You're going to cut me off. Okay, that's okay. That's good.
the gentleman's time's expired. Appreciate his comments and questions. We'll now yield 5 minutes to my friend Dan Kildee from Michigan.
Thank you so much, Mr. Chairman, and to temporary ranking member Scott. Good to see you. Thank you. Listening to my friend from Wisconsin, it's obvious that there are some areas where we have significant disagreement, but interestingly enough, some areas where we might find agreement when it comes to tax policy. So I do think it would make sense for us as a body, and I serve on the Ways and Means Committee, the Tax Writing Committee, to try to focus on tax policy that is a bipartisan approach. It's very difficult to do, I acknowledge it, but if we're going to have sustainable policy, we're going to have to figure out a way to do this in a bipartisan fashion that ensures that people and organizations pay their fair share, and that the obligations for those who have significant resources are applied to them. And also that we do have incentives built into the code. Now, we can argue about whether or not we do a direct spend approach or we use the tax code as a way to get at it. It is a blunt instrument. But I don't think we can deny that there are priorities that are federal priorities that we ought to focus upon. And I do believe that housing, a fundamental aspect of the hierarchy of human needs, ought to be on the agenda for the federal government. And whatever method we want to use to get at it, I'm interested in a conversation on that. But I think, unfortunately, what we've seen most recently in the legislation that House Republicans have advanced doesn't meet those tests. It doesn't substantially cut taxes for working families, certainly doesn't deal with some of the needs of the most at-risk people that we face. And we've had conversations about the low-income individuals. We certainly had conversations about the child tax credit, but that didn't make it into their legislation. Instead, it overwhelmingly would cut taxes for the largest and wealthiest corporations. So it's not a fiscally responsible approach. It increases our deficits and exacerbates the inequities in the tax code. So, I mean, obviously, we may not all agree on that particular point, but I think any thoughtful analysis of the Republican plan would cause that conclusion to be drawn. We saw, for example, as a result of Republican tax legislation in 2020, 55 of the largest Fortune 500 companies don't pay federal taxes. I don't think anybody can defend that when those organizations and high-wealth individuals pay less in federal income taxes than a teacher in my communities of Bay City or a nurse in Saginaw or a factory worker in Midland. So I'm disappointed in that. But Mr. Mazur, I wonder if you might just take a moment to comment on the economic and fiscal benefits of first cutting taxes for workers and middle-income families to grow the economy, and second, making sure that those large corporations and wealthy individuals pay more, just to be blunt, more meaning their fair share, in order to reduce our deficit. I mean, it's a fundamental question, but that really is the question before us.
No, let's start the second part. Basically, if you have a set of goods and services that the federal government is providing, you should find a way to pay for them. And the system that we have in place does not raise an adequate amount of revenue to meet that. And so you need to find sources of additional revenue. And you're right to focus on large corporations who are paying nothing or small amounts of tax, and high-income individuals who similarly pay less tax than folks further down the income distribution. So that'd be the first place to start. I guess in terms of tax cuts, I'd put that a little bit aside before you got the fiscal house in order. Tax cuts are not going to be a driving force for making the economy work better, right? You want to have a good labor force, good infrastructure, well-educated population, and so on. Tax cuts are sort of secondary to that.
But in that context, though, when I think about tax obligations, if you could just briefly address the economic impact of, say, for instance, the refundable child tax credit.
So refundable child tax credit, we saw this occur when it was paid on a monthly basis. We saw it improve the life situations of the recipients significantly. And so that's a situation where getting additional money into the pockets of those people was a good thing. Whether the tax code has to do that or some other way is a discussion. I mean, I'd be much more in favor of increasing the minimum wage than increasing the child tax credit by a similar amount.
Well, I appreciate that. I appreciate this conversation. Obviously, we have a lot of work to do, but I would like to pursue some areas of common ground. Mr. Grothman made a mention of a particular tax provision that I think we all could maybe have a conversation about, and I appreciate the fact that the witnesses at least share some common ground when it comes to that subject. With that, thank you, Mr. Chairman. I yield back.
I thank the gentleman from Michigan and yield 5 minutes to my friend Rudy Yakum from Indiana.
Thank you, Mr. Chairman. I ask unanimous consent to submit into the record a report from the Heritage Foundation titled "The Tax Cuts and Job Act's 12 Myths Debunked."
So moved.
Thank you, and thank you to our witnesses for being here today and to share your expertise on this critical issue. It's no secret that state and federal tax policies strongly impact economic growth and opportunities for all Americans. Every tax dollar that the IRS collects is a dollar that hardworking families don't get to put towards food on the table or a night out at the movies. And it's a dollar that businesses don't get to put towards raises for their employees or capital expenditures. Repeatedly, we've seen the positive impact of tax cuts on everyday Americans. For example, in the 2 years after the passage of the Tax Cuts and Jobs Act, real median household income increased by over $5,000. Yet President Biden and congressional Democrats continue to push for higher taxes and spending with complete disregard for the impact on inflation, the impact on long-term economic growth, and the impact on American, and even more specifically, Hoosier families and businesses. The American Rescue Plan, which was ran through without a single Republican vote, supercharged inflation, saddled everyday Americans and small businesses and small business owners with burdensome new paperwork requirements on transactions over $600. The Inflation Reduction Act, which was also ran through without a single Republican vote, imposed American manufacturers with over $100 billion in new taxes. Meanwhile, the Biden administration's loose regulatory interpretations have ballooned the cost of new tax credits to over 700% of their original projected cost. What we should be focused on is how to incentivize growth, how to incentivize more research and more development within the United States. For example, a study published in the Journal of Public Economics estimated that when a business received a 10% reduction in their R&D costs, they increased research spending in intensity by about 19.8%. Additionally, they found that most of the increased spending went to increases in wages and supplies. This clearly illustrates the broad benefits in allowing businesses to expense or receive tax credits for research and development. So my question for Mr. McBride to start, can you speak to the economic impact of R&D tax credits and deductions on everyday Americans?
Sure. So this gets to the discussion we were having earlier about consumption being a driver of the economy. It's true that consumption is about 70% of GDP, for instance, but it is investment that happens first to get to that consumption. It's investment that creates the income ultimately out of which we consume. And so it's investment that should be prioritized here, and that's what we should be discussing here. And it is R&D investment in particular that is incentivized by R&D expensing. So yes, it's very, very important provision.
And how would that help everyday Americans or even Hoosiers that, just median income Hoosiers?
So it leads to greater R&D expenditures. R&D leads to innovation. Innovation leads to better products, better consumer products, more efficiencies in the workplace, which in turn leads to higher productivity ultimately. And workers are paid based on their productivity. So that means higher wages.
Right. Estimates by the Cato Institute show that, quote, if Congress confiscated every dollar earned by individuals and businesses past their first $500,000, it would still be about $200 billion short of covering the cost of next year's projected $1.7 trillion deficit. Mr. McBride, do you believe that this shows that we have a spending problem or a revenue problem in Washington?
I think the clearest picture is from the CBO, and they simply do their 10-year projection. Looking forward, they're showing on average spending is going to be about 24% of GDP over the next 10 years. That's about 3 to 4 percentage points higher than the historic average. Okay, and then we have revenues also higher than the historic average, coming in about 18%. So I think that is all you need to know going forward, if it's spending or revenues that are the problem.
Thank you. And Mr. Mazur, part of my job is ensuring that Hoosiers and small businesses and families don't pay higher taxes. And that's a result of Washington's overspending. And in your opening testimony, you stated and complained that you now pay less taxes today as a percentage than what you did prior. So I just want to make sure that you're aware that the Treasury Department actually has a program where if you don't feel like you're paying enough taxes, you can send in additional dollars, and that would help make sure that my constituents don't bear the cost of the overspending here in Washington. Thank you, Mr. Chairman, and I yield back.
I'm well aware of that program. I also don't have a Roth IRA for a similar reason, that I enjoy paying my taxes because, like they say, taxes are the price you pay for a civilized society.
Thank the gentleman from Indiana, and now yield 5 minutes to my colleague from Oklahoma, Josh McKean.
Thank you, Mr. Chairman. I heard earlier today one of our colleagues, one of our Democrat colleagues, I wrote down the comment. They were concerned about, quote, a proliferation of billionaires in our country. It's an exact quote from what they said. They were also concerned, quote, that we have as the United States, quote, the highest number of billionaires in the world. It made me think about John F. Kennedy and his famous commentary that a rising tide lifts all ships, all boats, and how this ideology of wanting to weaken our country's ability to have people invest and create jobs, how it's taken over and it misuses facts. I greatly enjoyed studying the Tax Foundation state-by-state comparisons. And with the Tax Cuts and Jobs Act, what we know is the corporate income tax rate, which made America have among the highest corporate income taxes in the world, with the Tax Cuts and Jobs Act, we went back to the average. And then last year, if you look at the 2022 income tax collections, what you find is that the top 1% paid 42% of all income taxes. And the top 50% paid 97% of income earners, paid 97% of all income taxes. And the bottom income earners in the United States only paid 2.3% of all income taxes. So it's amazing to me the rhetoric that continues to come out when we already have 7 graduated tax rates. We're totally in contrast to what in the 1935s William John Henry Bocher once said: you can't help the poor man by destroying the rich man. You can't strengthen the weak by weakening the strong. You can't lift the wage earner up by pulling the wage payer down. It's just an astounding contrast in America that we don't want to create an environment that makes people successful. And then when you actually look at who's paying taxes, as I just recited, it doesn't match the rhetoric of we got to get them to pay more. So, Mr. Missouri, you made a comment about vertical equity. You defined it a minute ago about vertical equity is to get those who do better to pay more. With 97% of the income tax burden paid by the highest 50% of earners, and the bottom 50% of earners pay only 2.3%. And the top 1% that's talked about all the time pay 42% of all income taxes. And we're at the average of corporate income tax rates. And you look at where we're at historically in terms of our gross domestic product and the amount of tax collection, and we're on par with history of our nation. Can you explain to me where do you expect people to pay more when we have the system already in place?
Sure. So you're focused on income taxes. If you would go back to your constituents, probably more than half of them pay way more in payroll taxes than income taxes. And you're leaving payroll taxes out of the calculations here when you're going through who pays how much.
Can I ask you a question?
Sure.
Payroll taxes, you're talking about FICA and
I'm talking about, Social Security, Medicare.
Yeah, Medicare.
Yeah.
So what we know by looking at that is that when we look at our budget deficits, our annual budget deficits of $1.5 trillion this year, that's not inclusive of the insolvency of those programs you're discussing. Most of us, we know we've got to solve that problem.
Yep.
But that's a totally different conversation the way we're looking at budgets.
Not totally different. It's part of the entire fiscal package.
Of unfunded obligations, I agree with you there.
And you're
but-
right that you know how to solve this. There's like 6 dials you can turn. And you can get the Ways and Means Committee together to figure out how you want to address Social Security, whether you want to do something on the benefit side, the tax side, the retirement age side, cost of living side. There aren't that many dials.
Can I pivot one?
Sure, please.
I just need to pivot to the limited time here. I want to go back to something that it was part of your introductory testimony where you talked about the ability for us as a nation to look at a simplification of our tax code. We have about $100 billion expense to just pay our taxes in the United States. And the Tax Foundation has got some ideas, and I want to give you just a moment to talk about Estonia, what they're doing to simplify within minutes to be able to file your taxes, and what we can learn. What I love about what the Tax Foundation has done, state by state comparison, helps states get an idea of how you can improve the ability to find out what's working and look at the laboratories of experimentation, laboratories of democracy state by state, but also by looking at different countries. I'd like to have you speak in my time limit here. You got 20 seconds if you can talk about Estonia.
26. I think some people in Estonia might actually file their taxes in 20 seconds. The claim there is that you can file your taxes in 5 minutes or less. And we have talked, my friend Kyle here, we have talked to the folks in Estonia at the Ministry of Finance, and they confirm that indeed it's 5 minutes or less to file your taxes, which should be mind-blowing for Americans. But they do it because they have a very simple system, that actually collects plenty of revenue.
It's not 72,000 pages when you look
Absolutely
at
not.
court cases like the United
It's
States.
about 88 pages, the entire federal tax code. So it can be done.
Mr. Chairman, I yield. Thank you for your indulgence.
You bet. I thank the gentleman from Oklahoma, and now I yield 5 minutes to my friend from North Carolina, Chuck Edwards.
Thank you. Thank you, Mr. Chair. Mr. Mazur, I heard you mention something a while ago that seems to be a typical political talking point, and that is there are corporations in America that do not pay any taxes. Do you think they're doing anything illegal?
I don't know. I do know that they're taking full advantage of the laws and shifting income to other tax jurisdictions. And they're taking advantage of the tax incentives that are provided, whether they, Mr. Grothman was talking about some of the tax credits that they have available or the deductions that they have available.
And so do you think that's wrong, that they take advantage of?
So Congress used to have an alternative minimum tax for corporations, and part of the reason for having an alternative minimum tax was that it provided a backstop. It said, no matter how many deductions or credits you get.
Mr. Mazur, thank you for that. Have you ever paid alternative minimum tax?
Yes, I paid alternative minimum tax many times.
Yes, and you recognize that the reason that one would pay that is because there was no income in the first place. I mean,
No, that's not true. I paid alternative minimum tax personally when my income was probably around $200,000 a year, similar to your income. And it was because I had a lot of state and local taxes that are not allowed as a deduction under the alternative minimum tax.
I can tell you as a business person, I've paid lots of alternative minimum in tax, and it's because there was no income. And I believe that's what is the case with most businesses out there today. The goal of every business is to have income to be able to pay taxes. Would you not also agree that even those companies that do not generate income to the level to pay the income taxes that you might want them to pay
do pay Social Security taxes. They do pay FICA taxes. They do pay property taxes. They do pay unemployment taxes. There's still plenty of taxes out there for those companies that have not generated the income to pay. You do recognize.
Agreed, they
there's
pay a whole range of taxes. I agree with that.
All right, thank you. Mr. Pomerleau, the TCGA reduced the federal corporate tax rate from 35% to 21%. What did that do for international competitiveness?
So, as I described in my testimony, prior to the Tax Cuts and Jobs Act, the U.S. had the highest statutory tax rate in the developed world. In the Tax Cuts and Jobs Act brought that down to roughly about average. That had a couple benefits sort of internationally. So the first one is that it reduced the incentive for corporations to locate their profits in low tax jurisdictions. The amount a company can save depends on the differential in tax rates, and when the US had a very high tax rate and other jurisdictions had lower rates, companies could save more by shifting overseas. And the second benefit is it also reduced the incentive to locate intellectual property offshore as well. When a company is deciding where to place a highly mobile asset, they're going to ask themselves, all right, where can I get the highest after-tax return on this investment? And a lot of that is determined by the statutory tax rate that the U.S. levies, and bringing that down also discouraged companies from shifting those abroad.
As any CEO would do, they're trying to generate income for their shareholders, their owners, and so I appreciate you calling attention to the fact that if we want more American jobs, if we want more investment in the United States as opposed to places like China, then we need to create the environment for them to do that. Thank you very much. Mr. Kuhlman, what did the Tax Cuts and Jobs Act of 2017 do for small businesses?
I think from an overall environment, the passage of the Tax Cuts and Jobs Act combined with some of the emphasis on reducing regulations, we saw small business optimism at or near all-time highs right before the pandemic. Of course, the pandemic turned everything upside down. But business owners took the benefits and just reinvested it back in the business. According to a survey we did in 2019, 1 in 4 increased compensation, nearly identical number increased business investment, 16% hired new employees, 20% paid down debt. Overall, they plowed it back into the business or their obligations for the overall economic benefit of the
Thank you.
small
One more
business.
question I'd like to get to before I run out of time. 32% of small business owners reported raising their selling prices. Would raising taxes help the inflation that Americans are already experiencing today?
Short answer, no.
Okay, all right. Mr. Chair, I see I'm out of time. I yield back.
Thank the gentleman from North Carolina. Yield 5 minutes to my friend Lloyd Smucker from the Commonwealth of Pennsylvania.
Thank you to the chairman. Mr. Mazur, sorry about that. In response to a question earlier, you said we could make the tax system more fair by making it progressive?
It already is progressive, making it more progressive.
Okay. That's the point I wanted to clarify. And in fact, I'd like to enter into the record a report from the Joint Committee on Taxation, Mr. Chairman.
So ordered.
This is from 2018, and this report identifies the U.S. tax system as the most progressive in the developed world. You agree, generally?
I'm not going to quarrel with JCT since I used to work there.
Okay, yeah. So I think it's important we establish that, because if I had listened to your answer and not had more context, I'd have thought that the individuals on the lower economic scale are paying a higher percentage and lower. But I'll give you some numbers in here.
Okay.
And your point of excluding payroll taxes is a good one, because they pay payroll taxes. But without payroll taxes, the bottom 50% are paying minus 0.6%, minus 0.6.
In that year, perhaps, yeah.
They're- What's that?
In that year, perhaps, yeah.
Yeah, minus 0.6, because of the refundable tax credits, they're literally getting money back rather than paying it. That's the bottom 50%. Now, with payroll taxes, to your point, their average rate, according to JCT, is 6.3%, compared to the top 0.1% are paying on average 33% of their taxes. So it's the most.
Interestingly, though, if you were to break that top 10th even finer, so like the Treasury Department used to put out the top 400, and now they put out maybe the top 0.001%. But basically, the top sliver pays less than the top 1%. So it kind of goes down at the top end.
They don't have that on here, but, I'm willing to look at that.
You could ask
That'd be
JCT,
interesting.
they'll go for it.
But, you know, one of the statistics that they list on here is that the top 0.01%, top 0.1% pay 30% average federal income tax rate. Well, I'm sorry, I just made this point, while the bottom 50% is less than zero. Here's the point I wanted. Separate research, and this is from the Tax Policy Center, which is sort of a liberal leaning. Okay, yeah, you worked at all of them. They say, research, that the top 1% of income earners shoulder 25% of all federal taxes paid, in contrast to 53 million households in the U.S. that pay nothing at all. And in fact, 6 out of 10 households actually receive more in direct government benefits than they pay into the system. Again, just want to be sure that we understand what we're working with here. And the point about the Tax Cuts and Jobs Act making the system benefit more for higher income earners is false. No. Because CBO in 2021, and I'd like to enter this into the record as well. This is a 2021 report by CBO. And they state that the provisions of the 2017 Tax Act reduced the total estimate of benefits from income tax expenditures by 9%. And on net, those provisions made the distribution of tax expenditures more progressive, because most of the benefits reduced by the Tax Act would have accrued to households in the highest quintile. So we started with the most progressive, according to JCT, of developed countries, and we made it even more progressive with the Tax Cuts and Jobs Act.
I'm going to have to quarrel with CBO on that. You might want to look at the Tax Policy Center's work that was done on the Tax Cuts and Jobs Act. I think they come to a somewhat different conclusion. And it really depends on the time frame you look at.
Sure.
And it depends on, because the individual ones expire. And it depends on what you do with the corporate income tax.
Yeah, I'm just telling you what CBO said in their report. They said that our tax structure got more progressive after the Tax Cuts and Jobs Act. But Mr. Coleman, you know, I was a small business owner myself, understand the impact of tax policy and the benefits of growing a business. And I've heard from so many small businesses in my area who benefited from the Tax Cuts and Jobs Act. And I'm not talking about the top 1% or top 0.1%. I'm talking about people who maybe, you know, they had 10,000 more in their pocket at the end of the year that they could reinvest back into the business, grow jobs, and so on. And just wondered, what's the top provision that you hear about? What are some of the things that you hear about that have been most beneficial? And then how concerned are you about some of those provisions expiring?
Sure. Yeah, what we call the small business deduction, Section 199A, the 20% deduction for pass-through businesses, it had a great benefit for small business owners, NFIB members. 91% of them support making it permanent. 81% thinks it's very important. And just a quick example is a Pennsylvania business owner, David Cranston Jr. of Cranston Material Handling Corporation, said it is only a couple employees, but he said in real terms, this means I will be able to keep between $1,200 and $2,500 a quarter in my business that I would otherwise have paid in taxes. The ability to keep $5,000 or $10,000 in a year in my company is a big deal to a small business owner like me. Moreover, the cumulative effect over several years is substantial. They allowed him and millions of other businesses like him to be in a better position to take advantage of opportunities, grow, and improve. They're going to
Thank you. I know I'm way out of time. Thank you for your indulgence, Mr.
I go from thumping to gaveling.
Sorry about that.
Thank you, Mr. Smucker. And now we will yield 5 minutes to Dr. Michael Burgess from the great state of Texas.
I thank the chairman, and actually, let me start with a unanimous consent request for 2 documents. One being the Democrats' corporate tax plan threatens higher bills for manufacturers. The second, Chinese Communist Party-linked solar panel company could reap Inflation Reduction Act handouts with U.S. factory.
So ordered.
Thank you, Mr. Chairman. Staying with the Inflation Reduction Act for just a minute. They created 2 new corporate taxes. Mr. McBride, two new corporate taxes were created in the Inflation Reduction Act, 26 tax credit programs on top of an already complex and burdensome tax code. So I think your colleagues at the Tax Foundation, it's estimated that over $300 billion a year is lost in productivity due to the complexity of the United States tax code. So every Congress that I have been here, I have introduced H.R. 1040. This is a flat tax, a version of the same flat tax that was created by my predecessor, Leader Army, when he was here. And honestly, you referenced the Estonia tax code and how people can file their taxes in under 5 minutes. And wouldn't reducing the complexity of the tax code and perhaps flattening the rate a little bit, would that not have a positive effect on people's compliance with the tax code as well as overall tax collections?
Absolutely would. So the real world examples we have, not just in Estonia, but a lot of their neighbors in Eastern Europe, that's where flat taxes really took off in the 90s. Many countries there implemented flat taxes, and they did so because, one reason, they were having a big compliance problem. They were having all sorts of, major tax evasion with a complicated income tax like ours. So they came upon a solution, which is to simplify the rules, flatten the tax, toss out all the special provisions, and lo and behold, they found it generated better compliance and more stable and reliable revenues over the years. And so they stuck with those flat taxes, and then Estonia went further, and eventually with their business tax, they simplified it even further to this distributed profits tax. There's basically no taxable income. There's no calculation of taxable income at all. Instead, it's just a tax on whatever is distributed to shareholders. Taxing one stream rather than calculating all items of income and all items of expense, et cetera, and sending it to the tax authorities.
Well, it's a practical matter. They suffered from not bringing.
Right, say that again?
As a practical matter, has Estonia suffered from not bringing in enough tax revenue?
No, absolutely not. They generate revenues today, 20 years into this new system, that have essentially are pretty typical across the developed world in terms of income tax collections.
So just my own observation, living and working in this country in 1986 when the Reagan tax cuts were introduced and passed, the Bush tax cuts in 2004, and Chairman Brady's tax reform in 2017. My observation is you seem to have an increase in compliance. You didn't have to hire 87,000 new IRS agents, but you made things more straightforward, and people complied because it was easier to comply than it was to hide your income and try to not comply. Is that a valid assumption?
It's absolutely valid. When we have a tax code today that is 4 million words, I don't think any person on earth has the ability to understand something like that.
So, Mr. Chairman, in the time I have remaining, I'm going to have another unanimous consent request. It also deals with the Inflation Reduction Act. This is a page from the Federal Register from October 14, 2022, from the Department of Health and Human Services, and reports the establishment of the Medicare Drug Rebate Negotiation Group within the Center for Medicare. Most people did not realize that with the creation, or with the passage of the Inflation Reduction Act, the federal government will now have the largest and most secretive PBM that has ever been developed. Now, a lot of us decry the PBM because we say they only add complexity and they don't bring anything of value to the system. When you read through these words in the Federal Register, it absolutely describes a nightmare going forward. And of course, their enforcement mechanism is the tax code, a 1900% tax on any gross revenues that the company may create. So, Mr. Chairman, this is a very serious matter, and we haven't talked about it enough, but I do want to introduce this for the record, and perhaps at some point in the future, we can have a hearing on the deleterious effects on what's happening in the United States with the so-called mislabeled Inflation Reduction Act.
I thank the gentleman from Texas, so ordered, and now yield 5 minutes to my friend from Virginia, Mr. Bob Good.
Thank you, Mr. Chairman, and thank you to our witnesses. I think you're starting to see the light at the end of the tunnel here. Appreciate your investment of time today. I wanted to touch, with the limited time that we have, on a couple of the President or the administration's key policy priorities, energy or climate, as well as immigration/border and how they impact the economy. And a couple of questions to Mr. McBride first. Mr. McBride, the President has stated many times that his proposed tax reforms would help average Americans. How would you reconcile that or contrast that, or perhaps, with the estimate that 80% of the electric vehicle tax credits are going to households with incomes of $100,000 or higher?
Well, clearly that is, like you describe and like anybody can recognize when they look at the sticker prices on electric vehicles, that those are luxury goods. They are not targeting a low-income community with those products. Those are luxury goods that, as good as they are for the planet perhaps, they are very expensive, and they have been expensive for, ever since they've been produced. And so these tax credits, of course, then go to high-income individuals that can afford a $50,000, $67,000, up to $80,000 is what is allowed under these new tax credits towards that's the sticker price of an electric vehicle. Then there's a loophole around that, so that around that provision, and then the income provision. So that is the leasing loophole. And so none of the restrictions, as I understand it, apply to vehicles, electric vehicles that are leased. You can get the credit. It basically flows through the leasing company to the consumer. So, someone making millions of dollars a year, for instance, could lease an electric vehicle and benefit from the credit that way.
Yeah, it's really just obscene that we would, on the backs of regular taxpayers, subsidize vehicles for the wealthiest of Americans. And then as we're trying to force Americans to electric vehicles and restrict production of gas-powered vehicles, what's going to happen to the prices of gas-powered vehicles as their supply is limited? What is that going to do? We can only imagine and speculate what that will do. I also, consistent with what you said, reports that I've read are that the vast majority of electric vehicle owners, you use the term luxury, it is a secondary vehicle because of the impractical nature of it. It's impractical, insufficient number of charging stations, impractical for long distance travel, that sort of thing. The Biden energy agenda more broadly, combined with the massive inflationary spending, combined with the response, I would suggest misguided response of massively raising interest rates. So the housing prices are up, inflation is up, grocery prices are up, utility prices are up, gas prices are up. So let's sock the American people with higher interest rates to make it so they can't afford to buy homes, or we make the average cost of a mortgage go up about 50%. So your thoughts on how is his doubling down on his Green New Deal tax credits, how's that going to impact the economic or financial future for average Americans?
Well, I think that it was sold as an Inflation Reduction Act. Of course, that's the title. And that was all premised on the idea that it would reduce deficits, which was what was originally thought based on the original score from CBO and JCT. We now know that that score was off. It was off in the direction of actually underestimating the cost of these green credits greatly. And so we now, based on the new scores from JCT, it appears the IRA legislation as a whole increases deficits. It's not clear how much. We should hopefully get a new score for the entire bill to find that out. But if there's no deficit reduction in this bill, then there goes the idea that it reduces inflation.
Mr. Pomerleau, with the limited time that we have, I saw a study that says the net cost of illegal immigration in the United States, 16 million or more illegals in the country now, is about $150 billion last year, roughly $9,000 per illegal. Could you speak to the cost to the American taxpayer for the flow of illegals into the country?
Thanks for your question, but this is a little outside of my area of expertise. I don't know if anyone else has any thoughts on this issue in particular.
Well, I'll just say with the 8 seconds I've got left, it's funny, we have a law in this country where if legal immigrants can't be on the public dole, but illegal immigrants, if you break the law, your first act on the soil of the United States is to break the law, then we give you all the social safety nets, the social welfare, the health care, the social services that we can provide to you. So it's really incredible as we reward illegal immigration. I yield back, Mr. Chairman.
I thank the gentleman from Virginia and yield 5 minutes, I think, to close out our hearing. My friend Buddy Carter from Georgia.
Thank you, Mr. Chairman, and thank all of y'all for being here. And I promise you we'll be brief and try to get through this 5 minutes as quickly as we can. But I want to ask you, our current tax code, and I think most people would agree, it's built on government control, and it's built on trying to control actions of people and what they do. I've served in a number of different capacities. I've been a mayor, I've been a state legislator, and now I serve in Congress. I started when I was 10, so that explains that. But nevertheless, I've always noticed that people, given the choice between a property tax or an income tax, that they don't like taxes, but given that choice, they would prefer a consumption tax. Are you familiar, any of you familiar with the fair tax? Can you tell me, I'm the sponsor of the fair tax. The fair tax was started in the late 90s by John Linder, and then Rob Woodall, who was his chief of staff at the time, became a member after John left. Rob took his place, and then when Rob left, he asked me if I would carry it, and I did, and I'm proud to. It was the very first bill that I sponsored when I became a member of Congress. And tell me, if you will, what you think about a consumption tax and about specifically the fair tax in that proposal.
I think consumption taxes are good policy. I think that in general, they are less distortive than the income tax. They do not discourage investment. They do not discourage saving. And if they're structured well, they can reduce non-compliance in the tax system. The fair tax in particular, I think the policy, the heart is in the right place, but I think structurally...
Well, what would you change? Tell me, how can I make it better?
So I think the fundamental weakness of the fair tax is that it's a retail sales tax. I think retail sales taxes, they're collected all at the very last point in the chain of production at the retailer. And as a result, all the revenue is collected at that point, which creates a pretty significant incentive to avoid the tax, especially if the rate is high enough to replace current revenues. And I actually have a recent paper that I did that estimated how high the tax rate would need to be under the fair tax to replace current
And what did you come up with?
And with a reasonable amount of avoidance, which I think might be on the
And do you
low
think we have
end.
any avoidance in the current tax system?
So the current tax code does have avoidance, but I think any tax system has avoidance. And if,
But you think that
if
the
you
fair
would-
tax would have more avoidance than?
Well, in our paper, we assumed that it would have just the same amount as the
Okay,
current tax
fair
system.
enough,
We
fair
found
enough.
The
Continue
tax
on.
rate would have to be in the high 30% in order to cover the current tax revenue. So at a rate that high, I think a retail sales tax.
And what do we have it at?
Sorry?
What, in the proposal, do you know what it's at?
So in the proposal, you have two rates. you have a standard rate and a variable rate for the trust funds, and those in the first year add up to a tax-inclusive rate of 23%.
Right.
The tax-exclusive rate is closer to 29 or 30%.
Right.
But that would be insufficient to cover current revenues, plus
How do you base that assumption on that it would be inconsistent?
Sorry?
How do you base that consumption to be inconsistent to replace what we currently have in revenue?
So we did our estimates based on national accounts. So this was using BEA data and IRS data.
Okay, let me cut to the chase. What would you do differently? How would you improve it?
So I think, so first
Because
I think
would
that-
you agree, first of all, people prefer a consumption tax and that
so
people would have
personally
control?
I would prefer a consumption
And
tax
this would
over
give
an
people control as opposed to the government having control.
So I think that one of the weaknesses is that you're resting the entire tax code on a single tax, which can create problems with avoidance. I think having multiple taxes is good. And second, I think you can improve over
You
a
might be
retail
alone in
sales
that,
tax.
in that
I
assumption.
think you can improve over a retail sales tax with a value-added tax. Under a value-added tax, you'd be collecting the same amount as under a retail sales tax, but it would be done each stage in the production process. So if there's avoidance,
Okay.
it only ends up being a small amount of avoidance.
All right. Anybody else want to comment real quick? I'm sorry.
I agree with those comments. I'll just add further, what the VAT does, it has a bad reputation because it comes from Europe.
Yes.
But what they're doing makes a lot of sense, which is removing the cascading effect of sales taxes on business inputs as they go through the production process.
Well,
Retail
look,
sales tax, you know, has this
I'm
cascading
appealing
effect.
to you. I want help. I want to make this even better. So help me.
That's the best, the
Some
single
of-
best thing, in my view, that you could do to that is remove that cascading effect of taxes on business inputs.
Okay. All right. Well, we're hopefully going to be taking this up. So I need your help and I want your input. So I'm appealing to you to help me with that. Thank y'all. Appreciate it. And I yield back, Mr.
I
Chairman.
thoroughly enjoyed the dialogue, and I appreciate the time of our witnesses. In closing, just a quick thought, and then I'm going to ask my ranking member to close it up for me. But our first hearing was about the fiscal state of the nation. I don't think there was any disagreement that we've got problems, and those problems are getting worse very quickly, and that the financial health of the country is deteriorating rapidly. How we address that, I think there's definitely disagreement, but there's probably commonality as well. Today, we focused on one part of the equation, the revenue side, and the growth side. And I appreciate that good, open, robust discussion and debate. Here's my biggest concern that gnaws at me in every committee hearing, and that is that we have $1.5 trillion in the gap of the funding of our government that we borrow on the backs of future generations of Americans. And it is completely unsustainable. And so you have colleagues on one side that may want to raise taxes or some combination, and you have people like me who think we need to massively right-size and shrink the government and cut expenses, or some combination. But it is immoral, in my mind, to rack up this kind of debt and to stack it and shift it as a deferred tax on our children. And that's the unfortunate nature of the budget process, is that we just continue to perpetuate this to the demise, I think, of future generations. With that, Mr. Scott, bring us home.
Thank you, Mr. Chairman. I think if we just pay for what we do, we can balance the budget. I think Mr. Mazur pointed out that it's arithmetic. If you're going to have a new spending program, pay for it. If you're going to have tax cuts, just pay for it. And things won't get worse. And under Clinton, they got so much better. We were on course to paying off the entire national debt held by the public by 2008. Entire debt held by the public, and put all the money back in the trust funds by 2013. But you can't do it if you have unpaid spending or unpaid tax cuts. You got to pay for what you want to spend.
You know, I don't know, this is not a colloquy, but I actually agree with that. See, look here. I'm in the most Republican district in Texas. Whether you offset through a cut to pay for tax cuts, tax reform, or you raise revenue, because we rarely do, and we reach for the more expedient mechanism, which is finance it, which doesn't hurt anybody. We don't have to raise the tax and take any money out of anyone's wallet. We don't have to cut somebody's favorite program. When that happens and we can still grow the government, there's not a real rational decision as to, do we really want that? Can we really afford that? So those trade-offs aren't there in this unfortunate sort of fantastical system that we have today. If we had one that considered the cost that we paid for in one way or the other, I think we'd have a very different dynamic between the electorate and representative leaders of our great country.
That was PAYGO under Democrats, right?
Yes.
Good.
Yes.
Get it back.
Well, you know, Mr. Scott, I'm going to invite you up here to the upper deck more often. I think we may have to have an executive session about the ranking member job since he's gone. Thank you, Dr. McBride, Mr. Pomerleau, Mr. Kuhlman, Dr. Mazur, got that right, for appearing before us today. Please be advised that members may submit their written questions to be answered later in writing. Those questions and your answers will be made part of the formal hearing record. Any member who wishes to submit their questions for the record may do so within 7 days. With that, the committee stands adjourned.